Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Diane King Hall. Brad Smith is off today. And here are three things that you need to know this morning. Going from strength to strength, Nvidia blows past even the most bullish of expectations with first quarter earnings. Demand for AI chips like the H100 rocketed, with data center revenue up almost 15% on the year to $4.3 billion. The move further propels the stock that had already seen an astronomical 109% rise this year. The pop in the company's market value today, setting up to be among the biggest in history. On the earnings call, CFO Colette Kress said visibility for data center demand had now probably extended out a few quarters. And optimism from House Speaker Kevin McCarthy that a deal will be reached on the debt ceiling, and it's not enough for Fitch. The ratings agency has placed the United States on ratings watch negative as the uncertainty around the talks persists. What does it mean? Well, the move serves as a stark warning that Fitch could downgrade U.S. debt if lawmakers don't come to some sort of agreement, and fast. In a statement, Fitch cited, quote, increased political partisanship hindering reaching a resolution. We're approaching now the so-called X date, when the federal government effectively will not have enough money to pay all of its bills. And more retail reports help shine a light on the health of the U.S. consumer. Best Buy missing the street with revenue of $9.47 billion. It reaffirmed its March outlook, expecting a decline in full-year revenue and a comparable sales drop of between 3% and 6%. The retailer says it expects a slowdown in consumer electronic spending this year, and CEO Corey Barry painted a cautious consumer making, quote, trade-off decisions. It follows the narrative we heard last week from the likes of Home Depot and Walmart. That said, the shares are higher. Some of the components of the report may be a little bit not as bad as expected.
All right, let's dig into Nvidia. Call it Nvidia's AI-driven extravaganza. The chip maker is surging after blowing past even the most bullish of expectations with first quarter earnings. That stock tells the story of an artificial intelligence boom, and one company at the center of it all. Demand for AI chips like the H100 rocketed, with data center revenue up almost 15% on the year at $4.3 billion. Now, the move further propels a stock that had seen an astronomical 109% surge in the year before the results hit. Speaking on the earnings call, CFO Colette Kress summed up the demand story.
We have some significant supply chain flow to serve our significant customer demand that we see. And this is demand that we see across a wide range of different customers. They are building platforms for some of the largest enterprises, but also setting things up at the CSPs and the large consumer internet companies. So we have visibility right now for our data center demand that has probably extended out a few quarters.
All right, joining us now for analysis is Srini Pajuri, Raymond James Managing Director and Senior Analyst. All right, let's get right into NVIDIA's latest results. What was your first takeaway?
It was a stunning quarter. I mean, we've been covering the semiconductor space for about 20 years, and we have never seen a quarter like this. Our expectation was that the quarter was going to be strong. We thought if they beat the guidance by about 5%, that's good enough for the stock to stay where it is. But they're beating guidance by consensus by 50%. We rarely see it for a company of this size. The incremental upside here is about $4 billion. And most of that is coming as expected from data center segment, which is roughly about 70% of the mix. But the interesting thing about it is that, it doesn't seem like it's a one-off. Management seems to have visibility into the second half. And, there's a war going on out there in AI, and NVIDIA today is the only arms dealer out there. So as a result, we are seeing this huge jump in their revenues.
Srini, I have so many questions for you. Let's start on the AI front. I mean, ChatGPT just came out, 6 months ago, right? So
right.
I'm trying to wrap my head around why it seems like there's already so much sales flowing through to NVIDIA that are a result of this. And maybe on a related note, how many of the chips, what percentage of the company's revenue now can you say is directly sourced to AI?
Sure. AI has been around for many years, right? I mean, if you kind of look at some of the consumer applications, We have had Siri and Alexa for a while, Google Photos. But I think this, what we call the generative AI, ChatGPT, it creates content. There are so many applications. It's viewed as the first real killer app. And, the enterprises, and there's so many applications out there across so many industries. And what the hyperscale cloud companies like Microsoft and Google are realizing is that, they will lose competitive advantage unless they take the lead in generative AI applications. So as a result, as I said, it's a war out there, and everybody's scrambling to put out their generative AI products. And as a result, right now there's only one supplier of GPUs, and Nvidia has been investing in this market for the last 10 years. They not only have the chips, but they have the systems, they have the software. So it's a full stack solutions company. So to answer your question, as I said, data center segment is roughly 70% of Nvidia's mix today. I would say, more than half of that is directly related to, ChatGPT-like applications today.
That is incredible, Srini, because it is such a, as you say, AI has been around for a long time, but ChatGPT has not been around for a long time. So that's just an incredible boost.
Right.
NVIDIA has been really good at catching waves, right, at various times. Caught the crypto wave, right, caught the gaming wave, caught the metaverse wave, right? We heard about its omniverse a lot last year around this
right.
time. How do we know that this wave is not going to crest and crash like some of those prior waves?
Yeah, it's a great question. We get that question very often because of what we saw with crypto and even metaverse. But this does seem real because, if you look at the applications, the potential of generative AI, early on, it's primarily targeted towards customer service type applications, but it's going to boost the publishing industry. It's going to boost even the movie making industry and the healthcare industry. And there are so many applications, and it's so early, and that's the reason I think we are seeing these big cloud customers spend the way they are spending. And this is if you look at the macro backdrop, the overall cloud spending is coming down, but the generative AI spending is jumping there's no tomorrow, essentially. So it does feel real, but again, it's early days. We have to wait and see how long this sustains, but at least for the next 2 to 3 quarters, we feel very good about NVIDIA's prospects, and we also see this benefiting some of the other chip suppliers out there.
All right, Srini, you did mention the macro environment, and just about any company has to deal with macro headwinds. But let's talk about kind of one headwind specifically that would apply to NVIDIA, the slowdown in the gaming industry. Do you see that as any cause for concern, or are there any headwinds that you see that could be cause for concern when it comes to NVIDIA?
Yeah, look, macro is always a concern, and gaming primarily they sell to, the consumer market. So, that does get impacted. But the good thing is that, they have seen the worst, late last year because of the crypto bubble bursting, and they're coming out of that, trough. And on top of that, they also have new products. So every time they have pricing goes up because of the higher performance that they offer. So that is been a tailwind. So as a result, even that gaming revenue is recovering on a sequential basis, and our expectation is that as we go through the seasonally stronger second half, we'll see more growth out of that business. So overall, we think that that probably grows in the low double-digit rate, but data center is where most of the growth is going to come for NVIDIA in the next few years.
Srini, you mentioned that this is a one-horse race at this point. This is the only company that is making these GPUs for these generative AI applications. So does that mean you just buy NVIDIA and forget about everybody else? Where are there some other opportunities in chips that people should be looking at related to this new wave of AI?
Right. In the short term, NVIDIA is the only game in town. And as I said, everybody is scrambling to put out something as quickly as possible. And, but longer term, you got to think about, the cost and, the investments are going. I mean, if you look at the infrastructure investments today that are going into generative AI, we don't know if it's sustainable. So obviously the customers will look for alternative sources. We would say that in our view, AMD is the second best positioned company in the space because they also supply GPUs. And if you look at their market share in PC gaming, it's roughly 25-30%, and in AI, it's close to zero. So it's only natural to assume that they will make progress, and they have a new chip coming out second half of this year, and we're pretty optimistic about their prospects. And then we keep hearing about the big cloud companies trying to develop their own in-house silicon, what we call custom silicon. And one of the reasons, is they want to differentiate, because if everybody's using Nvidia, what's your differentiation? But the other reason is also on because of the cost issues. Nvidia's chips today sell for $25,000 a piece, their latest generation chip. By designing these chips in-house, you can reduce that cost pretty significantly. So, when the market moves to designing a custom silicon, there are two companies that come to mind, because you still need help from chip companies to design these chips. One is Broadcom, which we rate as market perform today, and they're already supplying to Google. And the second one we actually like is Marvell. They're very early, and they have all the expertise to design these chips, and we do expect their business to pick up in the next few years. So those are the two names that we would highlight.
And then finally, one last question on NVIDIA. On the call, Jensen Huang mentioned and teased perhaps another product introduction at Computex in Taipei, which I think is coming up in a week or two. Do you expect that to be yet another big announcement and cause another leg up in the stock? It was hard to even imagine what we're seeing today.
Yeah, look, NVIDIA, as I said, it's not just a chip company, they're a full stack solutions company. What that means is that, they make the chips, but they also make the subsystems, they make the systems, and they also supply full software solutions. So, one-stop, AI shop, essentially. So they're adding to that portfolio. So I'm not expecting, I'm expecting the announcement to be incremental because they're already so big in AI. And it's great to see that, because again, that's how they protect their moat, because they've built a very strong ecosystem, and that's the reason as to why they're doing so well, and they have to continue to invest, and that's what they're doing, and it's great to see that them do that.
Srini, really great insight. Thank you so much for your perspective on this as NVIDIA climbs 30% this morning. Srini Pajuri, Raymond James Managing Director and Senior Analyst, thank you.
Thanks for having me.
Well, America's political partisanship could cost the nation its AAA credit rating. Fitch Ratings placing the country on ratings watch negative, signaling it could downgrade if lawmakers are unable to raise the debt limit. While Fitch says it expects a resolution to be reached before the X date, lawmakers' failure to, quote, meaningfully tackle fiscal challenges signals risks to U.S. creditworthiness. In 2011, S&P gave its first ever credit downgrade to the U.S. Remember, it cut its rating to AA+. It sent Treasury yields down. More than a decade later, that agency still has not restored its ratings. Here to dive in deeper is Andrew Desiderio, Punchbowl News senior congressional reporter. Thank you so much for being here, Andrew. So what's the latest here, first of all, on the back and forth and what we know?
Well, I can tell you they made serious progress late in the day yesterday and overnight. The goal now is to have legislative text sometime over the weekend so that House members can be notified of what McCarthy has called his 72-hour rule, whereby members have 72 hours to review legislation before it's put on the floor for a vote. There are still lots of issues to be resolved, and today is going to be really important for that. But spending levels, seem to be very close on that. They're very close on energy permitting as well. And they almost basically have an agreement in principle right now on clawing back unused COVID relief funds.
Right. And Andrew, Diane here. So the COVID relief funds have been kind of the low-hanging fruit, or seen as the low-hanging fruit, and it's something that Democrats would have seemed to be recently willing to concede. But one of the sticking points has been this work requirement aspect that House Speaker McCarthy has been calling for concessions on. What are you hearing on where things stand in negotiations on that sticking point?
Yeah, that remains the biggest hangup right now. It's really hard for the two parties to find sort of a compromise position on this, because with spending, you could just adjust the numbers, right? With work requirements, it's either you have them or you don't, and you figure out sort of the extent to which they're implemented, who they apply to, things like that. So it's a much harder issue to tackle, and the White House is very concerned about this issue because, frankly, there are a lot of progressives in Congress who are not going to vote for any agreement. They've already said they're not going to vote for any agreement, rather, that includes new work requirements for social safety net programs. So that's going to be a big challenge for the White House as they try to figure out what can actually get the requisite number of votes among the Senate and House Democratic caucuses.
Andrew, I've been thinking a lot about this debt ceiling thing because we've been thinking a lot about it, or talking a lot about it here. And obviously, we've had this discussion so many times before. And the closer it gets, the more irritated I get. and I imagine like that's true of people in Washington. I imagine that's true of the public market participants. I imagine that's true of Americans. Like, it's just so dumb. The whole thing. I mean, I'm just curious. Like, do people inside Washington see it that way? Because the spending cuts that they're quibbling over are really marginal here for the overall size of the debt, if they're really serious about the debt. And like, why not divorce this from holding our debt rating hostage? I'm just curious, like inside the Beltway, if the view is the same as it is outside.
Well, it's certainly the same for those of us who have spent ungodly number of hours staking out Speaker McCarthy's office as these negotiators have come in and out and trying to get any morsel of information as we can. But I think, the root of this is that, Republicans control the House. They see the debt ceiling as a huge leverage point for them in a divided government. And frankly, it is. The debt ceiling is something that has to be raised no matter what. And if Republicans come to the table with a series of demands, it's up to the White House and congressional Democrats to sort of work with them and see if they can get a compromise, which is why they spent months saying, look, there should be no hostage taking, no brinksmanship surrounding the debt ceiling. We should just pass a clean debt ceiling bill and get this over with, and not, sort of scare the financial markets, scare the global markets, scare our creditors, things like that. But of course, politics rules all here in Washington, and Republicans see this as a very important leverage point for them. And it's frankly one of, if not the chief reason that Speaker McCarthy won the speakership in the first place.
But it's leverage for getting nothing. Like, is what they're going to win in this so important? Like, it just seems like the stakes are very high, and the ROI, to talk in Wall Street terms, is pretty darn low.
Yeah, look, I mean, especially the case if these spending cuts are quite modest, right? And you're going to have these hardliners who put McCarthy in the speakership in the first place, not end up voting for whatever bipartisan product comes of it anyway, right? The thinking is you're not going to get the far left and you're not going to get the far right to vote for this. So you're going to get the reasonable center of both parties to get this over the finish line, get 218 votes in the House, 60 votes in the Senate. So to your point, it's like, the people who are holding this up in the first place aren't going to be voting for the final product in the end anyway, right? So that's a lot of the time how these things work in Washington.
Andrew, to your point about scaring the markets, that has happened more, I noticed, in kind of the previous cycle, especially when we had the unprecedented event of the U.S. credit rating being downgraded. Now, there is the threat of that, again, this time coming from Fitch. Let's hone in on this timeline. June 1 being the X date, but there's still time needed to vote. Is there a way that the timeline, especially particularly the voting timeline for lawmakers, can be accelerated? Like, let's say the deal runs right up to nearly upon X date. Can the timeline for voting be accelerated?
Well, the 72-hour rule is something that McCarthy has said he's going to stick to, right? This is the idea that once legislation is released, the House will not vote on it until 72 hours after that, right? The House can usually process legislation in one single legislative day. The problem really is the Senate, where it takes unanimous consent by all 100 senators to speed up the process and really make things happen. Without unanimous consent in the Senate, you could see this take 4, 5, maybe even 6 days, legislative days, that is. So Chuck Schumer's going to have a really tough job if he wants to try to get this over the finish line as close to the X date as possible. It seems very, very unlikely, if not impossible to me, that both chambers pass a bill by June 1st, just given the current timeline, the current constraints, as well as the rules of both chambers, particularly in the Senate, where it's a lot harder to pass a piece of legislation than it is in the House.
Yeah, exactly. And to your point about running up on that date, we've done that before. And then there are problems that even when you do reach a deal later, there are problems. There's a ripple effect of problems that occur, like certain payments that have to be made, et cetera. But we're going to have to put a bookmark in our conversation for now. We still have days to continue this. So we do really appreciate you, Andrew Desiderio, Punchbowl News senior congressional reporter. Our thanks to you.
Thank you.
Much more to come on Yahoo Finance. We'll speak with Liz Ann Saunders, Charles Schwab, chief investment strategist, on the ongoing debt ceiling standoff as concerns surrounding the impending X date draw closer. We'll also get her thoughts on whether or not the banking sector turmoil could spark a broader financial crisis. Then we're looking ahead to the Fed's June meeting. Vincent Reinhart, Dreyfus and Mellon chief economist, joins the program to discuss the Fed's path for rate hikes and assess how the Fed is doing battling its ongoing fight against inflation. And we'll talk some investment themes with Rick Reeder, BlackRock Global Fixed Income Chief Investment Officer. He'll break down some of the biggest opportunities investors should be looking into amid economic uncertainty.
Another big story of the day, Florida Governor Ron DeSantis officially announcing his 2024 presidential campaign in a glitchy Twitter Spaces live stream with Elon Musk. A first for the app, and it definitely didn't go as planned. Joining us now on this, Yahoo Finance senior columnist Rick Newman and tech reporter Dan Halley. Rick, we could probably go another 15 minutes with you on the debt ceiling, but we've got you on something different today. I actually want to start with you, Dan, on just sort of the technology or lack thereof behind this. I mean, there's been so much talk about how many people Twitter has laid off and the effect it could have. Is that what this had to do with here?
It's hard to say, but woof, this is just a bad look for the technology side of things here. I mean, my God, there's supposed to be a marquee event basically showing off Twitter Spaces and kind of Elon Musk's big look. I've taken over this company. I've transformed it in my way, and this is the coming out party, and it was anything but. I've been reading different reports where the maximum number of people on the Twitter Spaces were between 500 and 600,000. By the time everything came back, they were on David Sachs' account. They were at maybe between 250 and 300,000, so dropping half of the people who originally were tuning in. It took a half hour to get everything back to normal. Or at least get going. Elon Musk has said that his account was part of the problem because he has more than 100 million followers, and then the thousands that were tuning in that somehow compounded to strain the servers. I think at one point they said the servers are melting. I mean, maybe that's the case, but it's not as though we haven't had streaming or live events streamed on the internet before. I mean, the Super Bowl is streamed on the internet. People stream. I was reading there were like 12 million people streaming a Travis Scott concert in Fortnite. So it's not as though these kinds of things don't happen. And don't happen without these kinds of glitches. I mean, it's hard to say whether or not this is actually the reason that Elon Musk put forward, or because he cut the workforce to basically no one and had to close down servers. And people have been talking about instability at Twitter as far as the product goes. So, it could just be that, or maybe it is what Elon says. But I mean, it's just terrible look overall.
All right, Rick, I want to bring you into this. Glitches aside, they did finally get it going. I was on for the glitch fest, if you will, for the first half. That, as Dan mentioned, took up some considerable amount of time. But once they got going on Sachs Space, on David Sachs Space, DeSantis jumped into things that he would talk about in his platform. And I want to just see what stood out to you in terms of what he mentioned. And also, I just want to make a note that it's clear that although Musk said afterwards he'd be willing to have any presidential candidate, certainly giving DeSantis a platform to speak to right-wing influencers, et cetera. What's your take on what he said?
So about 25 minutes into the event, DeSantis finally got a chance to speak. And he gave what basically sounded like kind of a canned stump speech. I mean, he talks about what he has accomplished in Florida. And what he is trying to do is he is trying to be Trump without Trump, or Trumpism without Trump. So he did not mention Trump, and he has really barely mentioned Trump at all. Even when asked about Trump, he almost never even says the name. But what he's trying to do is say he is a true conservative without all the drama that surrounds Trump. So that's the case that he's going to be making. So here's what I paid attention to last night. He is running on his handling of the COVID pandemic and pointing out that while other states and cities were shutting down schools and businesses, he kept schools and businesses open in Florida. And Florida basically had a better economic record through COVID. Okay, fine. But that is backward looking. And I'm not guessing that, the biggest thing that voters are going to be thinking about is how is the next president going to handle the next COVID pandemic? Because, we may not have another one. And then the other thing is DeSantis really hits hard on what he calls the woke mob and woke ideology. And I've been paying a lot of attention to this. This gets into his battle with the Walt Disney Company. There's just not a lot of evidence that many voters actually care about this issue. It is a kind of a hot button thing among the Republican base, but not among anybody else. And there are even some polls that show that, first of all, people don't even know what wokeism is. But among people who think about it, there are some polls that show people consider it more of a positive thing than a negative thing. So that's the battle that I think DeSantis is facing. I will just sum up by saying this. DeSantis is not a clown. Despite the horrible beginning to his campaign here, he's a very smart guy, and nobody should dismiss him on that regard. He could end up being formidable if he can get some traction against Trump.
Well, it's very, very early days still. So we'll see, and we'll see if he gets more chances to make his case on Twitter, and if Twitter gets more chances to make its case that it is, well, viable as a streaming platform. Thanks, guys. Really appreciate your perspective. I'm sure we'll be having more conversations like this. Yahoo Finance's Rick Newman and Dan Howley. Coming up, Dollar Tree is sinking in pre-market trading on its earnings report. We'll dive into those numbers. We've got other top movers, and we have the opening bell next. Welcome back. We're just coming up on the opening bell on Wall Street. Expect to see a divergence today. Strength in the Nasdaq because of chips, but not so much for the other major averages necessarily as we get underway this morning. The debt ceiling argument looming in the background still as we look at the setup for stocks. And then a Federal Reserve rate decision coming in just a few weeks. So all of that playing into market participants this morning. Let's do a quick check on the markets now that bell has rung, sponsored by Flex Shares. And we're still waiting, it looks like, for the Nasdaq to open up here this morning. And there it is, up 1.8%. The S&P up 0.9%. The Dow only down 0.1%. So there's that divergence that I'm talking to. And I want to go straight to the Wi-Fi Interactive to dissect what is going on here. Here are semiconductor stocks. This is what's going on, folks. Nvidia shares up some 25% and potentially looking, when all is said and done today, to be one of the record-setting days in terms of market cap value added in a single session because of the size of Nvidia and the magnitude of that gain. TSM, Taiwan Semiconductor, guess what? One of the main suppliers for Nvidia, those shares are up some 9%. ASML, chip equipment maker, up 5%. And then Broadcom up on that large cap spot there too, up about 2.4%. One of the stocks that is not rising this morning, Intel down 4%, not seen as one of the early winners here of the AI race. And so those shares are feeling a little pain. And then just to dig into it a little bit more deeply here, if we look at the Nasdaq 100 more broadly here, you see Nvidia standing out, but Alphabet is also up, Microsoft is up, Meta, all of these other companies that are playing in this AI space are also getting a lift, even though if you look on the right of your screen, not seeing certainly as much green there. And then finally rounding it out with the sectors, which again is going to show a similar theme. XLK, which is the Info Tech Index, XLC, Communication Services, both of them up. On the flip side, stuff that is more predominant in the Dow, like energy, consumer staples, that stuff is trading lower here this morning. So that's the opening trade, but let's get to some individual movers. Shares of Best Buy, they are popping it here as the electronics retailer. Its adjusted earnings per share came in at $1.15. That beat analyst estimates. Did miss on revenue, saw some steep declines in sales across categories, which you might expect. So it's interesting here, Diane. I guess just the expectations were pretty low going into
this. So they jumped over the bar was here.
Right,
like,
exactly.
Okay,
they hopped over.
Exactly. So, but they're optimistic. Their outlook is improving. They feel like the worst is behind them in terms of the trade away. They said they're noticing customers doing some trade down. And we did expect for them to suffer in terms of their performance compared to other retailers because consumer electronics. One, we saw this surge during the pandemic that has certainly cooled off, but now they feel like the worst is behind them in terms of sales. But, so they're getting a little bit of a pickup in action today, but they're down double digits year to date. So,
and I guess the momentum of the declines is slowing a little bit. In other words, the overall comparable sales this quarter down in the neighborhood of 10%.
Yeah.
In this current quarter, it's going to be a drop of 3 to 6%.
Yeah.
So it's bad, but it's not
as bad. Exactly.
And I guess that, along with the earnings beat, seems to be what's responding. You see there some of the individual groups there. Those are the comp sales. Computing and mobile phones down a lot. Consumer electronics down a lot. Appliances. Entertainment, interestingly, just interesting to see.
I was surprised by that number.
Sales on the rise. Actually, those aren't comps. Those are the overall sales that we're seeing gains. But comps also saw gains in entertainment. So. Interesting.
I know. And they're still dealing with inflation pressure as well.
Yes.
So, that will continue to be a headwind clearly for Best Buy.
Definitely. All right, let's talk about Dollar Tree as well. Those shares are going down, and the fall now is amounting to some 14%.
14% now.
Missing on profit expectations, cutting its full year outlook as well. And this is really a surprise.
I was surprised
by
that one.
Right, because the thinking was...
it's a discount retailer.
Yes, that it would be benefiting. People are trading down, and that did not seem to be the case.
Exactly. I thought it would, gain continue to hold on to its market share because what we saw with Walmart. And because of their pricing, they could continue to hold on to their customers. And I expected to see the same kind of story with Dollar Tree, but, they saw a profit decline. Sales did rise, but again, they just that margin wasn't there.
Yeah, the
right?
margin really seems to be the issue here because, yes, it might be selling more food, but food is a lower margin business.
Right.
Somebody like Walmart can absorb that to some extent, right?
Because they sell everything.
Because they're doing so much volume also. Now, Dollar Tree's doing some volume, but the margins are shrinking, to your point, because food is lower margin. But there's also some other one-offs. They did talk about shrink as well, that sort of retail euphemism for theft.
Yes,
but also,
exactly.
there was a rat infestation at a warehouse in Arkansas.
Oh, I missed that one.
The company shut that down, but there was a legal reserve of 12 cents a share that was a cost tied to that. So
that certainly hit their bottom line.
Presumably that's not happening again. But
hopefully that's a one-off for them.
That is a one-off, but that's something that also affected the numbers.
Yeah, exactly. And so again, different picture. We're looking at that chart where Dollar Tree shares sinking down 15% on the day, down for the week as well. So definitely not benefiting again in that we had this tale of two retailers. They're not on the side. No. They're not on the good side.
Definitely not.
No. Meantime, Snowflake is trending on Yahoo Finance today. That stock initially falling after hours on Wednesday after its sales outlook missed street expectations. Currently on decline now, down 13%. The company also warned that its customers may start trimming their cloud software spending given the macroeconomic uncertainty. So this was another surprise for me. I expected them to perform better than they did, and it's a miss.
Yeah, it is definitely a miss. The company, this is one of those words, growing. It's just not growing as much as expected.
Yeah.
Right, exactly. So the company said in the current quarter, product revenue is going to be up about 34% to $625 million. Analysts had been looking for about $646 million. And that's the biggest part of their of the company's revenue. So that's one of the things that was disappointing as well. And you also, when you're talking about these big enterprise software companies, you're really focused on large customers.
Right.
And so the company said by the end of the quarter, of its around 8,100 customers, 373 were large clients who generated product revenue of more than $1 million. That is up 80%.
Right.
From year over year. So that would seem to be positive, but obviously, people focusing on some of the numbers not being as good
exactly
as expected.
Today. And so again, when we look at a chart for how the stock has been performing, it had been doing well
up into the numbers,
but taking a big hit today. So we'll see how they recover from this one. All right, we'll put a pin in some of those trending tickers. Meantime, coming up, why our next guest says earnings have been better than expected, but at a very low bar, as we just talked about. We'll speak with Charles Schwab's Liz Ann Saunders. That's next. All right, let's head right over to the New York Stock Exchange now for a closer look at how markets are moving this Wednesday morning in the early action. Yahoo Finance contributor Remy Blair is right there on the ground. Remy?
Well, Wall Street has opened on a mixed note on this Thursday morning, but we are seeing that move higher for the Nasdaq. The Nasdaq Composite Index is up by over triple digits and posting over 1% gain on the heels of blockbuster earnings from Nvidia. And following those strong quarterly results and guidance out from Nvidia, we are seeing semiconductor-related shares higher as well. Let's start out with a look at Taiwan semiconductor manufacturing. Shares did pop by as much as 9%. And this did come as the chip maker does manufacture GPUs for Nvidia. The company could be a major beneficiary on surging demand for chips by Nvidia. Now, TSMC can expect a spike in orders if Nvidia does sell as many chips as expected. Now, moving on to ASML, the Dutch firm is also getting a lift this morning with shares higher by over 4% in New York morning trade. The semiconductor equipment maker is also the only company that makes the extreme UV lithography machines needed to make advanced microchips. And last but not least, taking a quick look at Intel, shares of the company are lower in New York morning trade. Keep in mind that earlier this week, Intel did announce its roadmap for its AI chip, which will be named Falcon Shore for AI as well as scientific computing, but it does not expect that chip to be introduced to the market until 2025.
All right, Remy Blair, mixed market this Thursday. Thank you for the correction. At the New York Stock Exchange, I gave us an extra day. Sorry about that.
We are ready for the weekend. Come on. Investors are expecting the Fed to take a breather at the much anticipated June meeting, pausing further hikes for now. Now, despite this, expectations they can move another quarter point higher have ticked up in the last couple of weeks. Notes from the Fed's May meeting out yesterday reveal officials were split on further rate hikes, several participants noting that if the economy followed the projected outlook, further policy firming, quote, may not be necessary. Joining us now is Liz Ann Saunders, Charles Schwab, Chief Investment Strategist. Good to see you, Liz Ann.
Good morning.
You wrote a recent note where you sort of looked at the history of what happens to the markets once the Fed is done with a rate increase cycle. But you sort of couched it in a healthy dose of this time won't necessarily follow the other playbook. So how should we think about if the Fed is done, what then happens?
You know, it's funny that you said playbook. There actually really isn't a playbook. And I wrote about it both in a report, but I also am a column contributor to Financial Times, and it went in there. And, you know, you don't have a long history of rate hike cycles. And too often I see comments like, well, the typical move after the Fed pauses or the average move. And it always brings in my mind that phrase of analysis of an average leads to average analysis. And if you do look at the average, you think you see a pattern, but the reality is you've got a 30% swing. I think that's what we're showing here. 30% swing from minus 30% to plus 30% in terms of what the market has done 6 months after the pause. So there's so many extreme examples. It comes to, well, what are the background conditions? And the background conditions right now, I think, suggests that you're probably not going to follow the average, not to mention the fact that I think there's a little added uncertainty with regard to something else going on in Washington. So I think you have to be really careful about looking at an average or even a median when you have historical ranges as wide as this, not to mention the fact that we're seeing probabilities move closer to 50-50 for the June meeting from a much higher likelihood of a pause just a few days ago.
Liz Ann, let's switch gears a little bit and let's talk about this debt ceiling debate that's been going on, negotiations, if you will, that's been going on. We've been here before, and now you have kind of this cloud on the horizon with Fitch threatening downgrade to the U.S. credit rating. When we saw this before, we certainly saw a dramatic impact on markets. It doesn't seem to be, the threat of that now doesn't seem to be as dramatic of an impact. Why?
You know, that's a good question. I'm not sure why. And I certainly hope it's not the case that we have to go through what we went through in 2011, where it took a riot on the part of the market to light a fire under the feet of Congress. We also have to remember that when S&P did its downgrade in 2011, it was after a deal was struck, not before. And I think the Fitch warning should be taken seriously. And even if a deal is struck, doesn't necessarily mean that they won't downgrade like S&P did. The other interesting thing that happened was back in 2011, there was an initial concern when you saw the downgrade about institutions, pensions, foundations, endowments, many of which had in their bylaws that they couldn't own any government debt less than AAA rated, that there would be, mass selling. It turned out what most of those institutions did was just amend the language. And what I'm not sure is whether that language was amended back, probably not. So it may lessen the concern if Fitch does a downgrade that there's going to represent forced selling, but it's not a good thing if we've now had in the last, 12 years, downgrade of U.S. debt by two different agencies.
No, it's not. Although, to your point, last time we saw people actually buying U.S. debt, which was sort of counterintuitive at the time following that downgrade. So we've got the backdrop of that. We've got the backdrop of the Fed doing whatever it's doing. And something else that you pointed out in a recent chart is what we are seeing in consumer discretionary and staple shares sort of versus one another versus the S&P 500. And we've seen this play out during this earnings season, by and large, with some exceptions. The theme being that people are using more discretion in their spending and not maybe buying as much discretionary. So how are you thinking about that also consumer spending backdrop and how it relates to stocks?
I think it is really important at this point in the cycle to take a more nuanced approach to looking at how the consumer is doing, whether it's looking at the relationship between discretionary and staples. Even within singular categories, look at what the behavior of consumers are. And we're hearing it from not just, big box retailers, but up to luxury retailers, that there is a shift in consumption patterns, in behavior, either moving down the price and value spectrum. You're certainly seeing it with lower wage consumers just trying to be smarter about their spending. In addition, when you look at other metrics that judge consumer spending, like retail sales, for all the cheering of the strength of retail sales, we have to remember that it's reported in nominal terms. If you look at real retail sales, are actually lower than they were 2 years ago. So also important, given that although inflation is down, it's not low. Any data that is reported in nominal terms, we have to continue to also look at it in real terms because, pun intended, that's the real story.
And I want to ask you about another sector. It hasn't quite been top of mind, or at least at the top of the news headlines lately, the banking sector. What is your analysis of is there still cause for concern, say, with regional banks or the greater banking sector?
So it looks like we've calmed some of the contagion issues that came about in not just the immediate aftermath of SVB, but the concentration of the 3 out of the 4 largest bank failures. And that's a function of sort of the implicit backstops, the actual funding facility set up by the Fed. And we get that data on a weekly basis on Thursdays, looking at how much utilization there is of those funding facilities. So a lot of that initial turmoil seems to have calmed, but we have to remember that there's the commercial real estate problem, particularly in offices. And when you look at the smaller regional banks, sub $10 billion, that's where the concentration of exposure is. In those smaller and regional banks, it's more than 50% of exposure to commercial real estate, where the ultra large banks have mid-single digit exposure. So that's not necessarily a momentary shoe to drop that's coming. It sort of works itself out over a more extended period of time, but it's kind of a double whammy for many of those banks that they're dealing with deposit flight. Now, in many cases, they're above the threshold in terms of loans to deposits, and they're more exposed to the problems within commercial real estate, specifically offices. So you're probably going to continue to see some weakness, consolidation, and maybe a bit more power in the hands of the larger banks.
Lizanne, putting everything that you've talked about sort of together and sort of vibe-wise, what I'm getting from you, you don't sound like you're super effusively optimistic right now. You talked in your notes about the S&P being in a range, and it doesn't sound like there's anything in what you're saying that would cause it to break out to the upside. or maybe the downside either? Are we just stuck in this range for the foreseeable future?
Well, yeah, the overall index has been stuck in a range, and we've had, higher lows, but we haven't seen that breakout on the upside. We've got the concentration issue that everybody's now very aware of, which I think started because of the macro backdrop of the bank failures, but then has that AI kicker to it. And we all know from history that heavy concentration can't last in perpetuity, but can last maybe longer than a lot of people can remain solvent. And this is, to me, reminiscent of the birth of the internet and what a game changer that was. And remember, Alan Greenspan used the irrational exuberance comment in 1996, and the market didn't peak until 2000. But I'd feel better if I started to see better breadth, improved participation by the average stock, so to speak. You only have 33% of the S&P trading above the 50-day moving average, 43% above the 200-day moving average. You want to see better participation. Interestingly, back in October, when the indexes took out their June low, under the surface, breadth had actually improved. And that's the kind of positive divergence you wanted to see. But since the kind of mid part of March, we've now seen that concentration risk, but it can last a while. Our advice to investors is just don't get greedy. It's not an all or nothing thing, but no one ever went broke. Just trimming and taking some profits along the way as we wait for some sort of convergence that will inevitably happen. Knowing the timing is impossible.
So you say don't get greedy, obviously, but where should investors be turning in a market like this, where you have both the backdrop of the issues with regard to the debt ceiling, whatever the Fed is going to do in its June meeting, and then this earnings picture that has been kind of generally speaking better than expected, but we've talked about this before, a low bar. Where should investors be turning? What sectors?
So we've been sector neutral for more than a year now, believing that making investment decisions or equity decisions based on sectors is a bit monolithic. In contrast, we think taking a factor-based approach, another word for characteristics, and we continue to stay in that mode with kind of a quality wrapper around the factors we think you want to screen for. And they represent kind of what's missing in the macro environment. So you want companies with strong balance sheets that are self-funding. They don't need to come to the capital markets or the banking system to run operations. You want to look for strong free cash flow yield, positive earnings revisions, positive earnings surprise. And so we think that is the way to approach the market. By the way, leadership at the factor level has been more consistent than leadership at the sector level. Even the mega cap 8, which that's where the concentration has been, people think of them as all tech, but they actually span tech, consumer, discretionary, as well as communication services. So even wanting to do sort of a chase the move in those mega cap names, just buying the tech sector doesn't give you that exposure. We think that's one of the reasons why we think you want to stay more factor oriented, especially with that quality wrapper. This is not the time to go down the quality spectrum.
Liz Ann, great to see you as always this morning. So thanks for spending some time with us. Liz Ann Saunders is Charles Schwab Chief Investment Strategist. Thanks. Coming up, Medtronic posting an earnings beat for the quarter, but those shares are down. We'll tell you why next. Now it's time for today's trending ticker. It is Medtronic. Those shares are down more than 5.5%. The medical device maker issuing a weaker than expected annual forecast, saying it expects U.S. dollar strength to drag on sales in international markets. But the company's fourth quarter did beat estimates with stronger than estimated revenue, thanks to a post-pandemic rise in non-urgent surgical procedures. The company's been focused on restructuring its core units over the past few years, but surging inflation and supply chain constraints have weighed heavily on costs.
Meanwhile, coming up, why our next guest says the Fed is paddling upstream in a river of doubt. We'll speak with economist Vincent Reinhart. That's next. Welcome to Yahoo Finance Live. I'm Diane King Hall alongside Julie Hyman. Let's get right into the market action. Right now you're seeing markets trade mixed in early trade. Dow under a little bit of pressure. Nasdaq and S&P 500 on the plus side. You're really seeing strength in the Nasdaq thanks to those chips, in particular Nvidia, giving a lot of strength there. But we've got some breaking economic news to get into. Julie Hyman, take us through it.
Yeah, we got pending home sales out for the month of April, not changed at all. The economist estimate was for a gain of 1% month over month, and instead we are seeing no change in those pending home sales. The prior month, March, saw a 5.2% drop, so it still represents an improvement, but not much of one, and worse than estimated one. So we've got our Danny Romero here with us on set, who is also analyzing the data, and it looks like we're really seeing a lot of discrepancies between regions that cause this overall number to not see any change.
Yeah.
Yeah, so the results really show that the spring selling season really didn't start with a bang. Buyers are still having a really hard time, moving from those sidelines due to that limited inventory that we're seeing in the resale market, as well as those higher mortgage rates. But if we break this down regionally, in pending home sales, the Northeast took a hit, still is taking a hit. I mean, we've been kind of seeing that trend move along. The South has sales activity compared to 2001 levels. That really stood out to me in the data. The Midwest decreased about 22% in their sales. So those pandemic boom towns are really cooling off, and we're really seeing that right now. Not really much enticement there, but also mortgage rates. If we reflect back in April, mortgage rates were they were ranging between 6.27% to 6.43%. So now they're sitting around 6.39%. So affordability still remains a concern, Julie.
Well, I want to ask you, you talked about the regions and some of the sticking points we've seen there, inventory being an issue. But in the Northeast, for instance, I look at Zillow every now and then to see what's out there. It seems like pricing is still pretty strong, and it seems like it continues to be a seller's market. Does that seem to be one of the sticking points that is in the Northeast?
Well, for the Northeast, I would just say that from what I've been hearing, just anecdotally from just the experts that I've spoken with, is that we're really seeing, sure, we're seeing prices decline, but they're not going super down, right? I mean, they're still pretty elevated. Not enough, right? Not enough to really push these buyers. And we're seeing that in the data right now, right? To really sign that contract. That's what pending home sales really shows us. It's a good gauge, a good indicator on the health of the home buyer, right? And so I think the Northeast will be taking some pressure, but like we said, those pandemic boom towns are also taking some of the heat too, right? They're not really seeing that surge that they really saw during the pandemic. So there is some cooling off, but of course it goes back to that affordability and the inventory issue that we're still dealing with. But public home builders are really being enticed right now and coming up with incentives to really bring buyers into that market.
Yeah, well, we'll see what it continues to show. Thanks, Danny. Appreciate it.
Thank you.
Well, otherwise, we are watching, of course, concerns surrounding the impending X date drawing closer. Investors are looking ahead to the Fed's June meeting as well. Expectations the central bank could hike another quarter point have ticked up in the last couple of weeks, but a pause does seem to be at least the majority consensus right now. Our next guest cautions that if the Fed does say pause, investors will then expect the red light of stop, as he puts it, to shift to the green light of cut. Vincent Reinhardt, Dreyfus & Mellon chief economist, is joining us now. Vince, it's good to see you. And we have heard some folks bring it back to the fore, the narrative of, well, maybe it is just a skip rather than a pause. In other words, they could perhaps then raise at further meetings. But the market doesn't seem to have digested that message, does it?
Well, there is some chatter among policymakers that they're talking about a pause. I think they lack introspection because once you skip a meeting, it becomes much harder to change the policy rate the next meeting. Think back just at the turn of this year, how much trouble they had adjusting the pace of firming. They cut the pace back a little bit too early, but then they couldn't adjust it because they had set this precedent. They're going to run into the same problem. If they stop, they stop.
All right, Vincent, I got to ask you about the debt ceiling debate that we have been going through once again. We've been here before, always up on the X date, if you will, it seems. So what should we be concerned about besides this deadline in front of us? Are there any spending payments that would be?
A couple things to worry about, actually a lot of things to worry about. Working back from the broader economy. The solution, whatever it will be, will involve a slowing in the pace of federal spending. It is going to be therefore leaning into restraint as the economy is slowing. So that's the big macro story. What you really should worry about, what I worry about, is that the X date is actually the far moment when the bad thing happens. Because when you think about it, falling off over a cliff is a bad thing, but probably even worse are the moments before you're about to go over the cliff and you appreciate that your momentum is such that it's inevitable. That's Janet Yellen's position. The secretary is going to have to queue up some infrastructure instructions about prioritization, about how you'd handle potentially defaulted Treasury securities. So in fact, we're going to get market moving news before the Treasury actually runs out of cash.
As we know, Fitch is considering a downgrade for U.S. debt. S&P never upgraded it again after they downgraded U.S. debt back in 2011. It seems like when we talk about this, a lot of the effects are sort of temporary, right? There's bills that don't get paid in the short term, but then eventually they will raise the thing, whether it's now or later. Are there any lasting economic effects, though, that we need to think about as a result of all of this?
Well, it was in Fitch's notice of putting the U.S. on credit watch, and it's why, as you mentioned, S&P is where it is. The debt ceiling debate is symptomatic of a broader problem. We can't have a grown-up conversation about fiscal policy. The U.S. federal debt is large relative to our GDP. Maybe it can be large because we're such a big country, but it's on a trajectory that seems unsustainable, and something that's unsustainable stops. And does it stop because the markets get tired of continuing to add more and more of debt? That's what Fitch is worried about. That's what S&P is worried about. The debt ceiling is a symptom of a broader problem.
But Vince, is it a mistake to couple that what should be a grown-up discussion about this with the whole debt ceiling structure at all? Doesn't it make more sense to just divorce the two entirely, have the debt ceiling just be increased? It's stuff that we already committed to, and then have the spending discussion separately.
Sure, there's lots of things that make more sense. and the basic political economy here is that the Congress is so divided along partisan lines, there's no opportunity to pass legislation. There's no opportunity to have a meaningful discussion, to have a blue ribbon committee to chart out a longer term course. At that point, then politicians have to look for their points of leverage. What's the must-pass legislation? And unfortunately, every couple of years, the must-pass piece of legislation is the debt ceiling. So this is their opportunity to be in the bright lights. They're taking it. And does much of this make sense? Does the whole idea of a debt ceiling to have a limit on the amount of debt you issue?
Let me jump in, Vincent. Sorry to interrupt you, but yes, to your point, do we just need to get rid of the debt ceiling? Like, should it just go away?
Okay, so people of a certain age, like me, who've worked on the debt ceiling for a long time, I was the point of contact when I was at the Federal Reserve for 25 years. All have a shared experience, and that was when Senator Robert Byrd, the late senator from West Virginia, would reach into his coat pocket and bring out his copy of the Constitution. And he'd remind everybody in the room that the ability to issue debt in the name of the U.S. government is a prerogative granted by the Founding Fathers to the Congress. The debt ceiling is a mechanism in which they extend that privilege to the Treasury, provided they satisfy a condition, keep the debt under the limit. The Congress isn't going to give up that prerogative. That's from the Founding Fathers. There's always going to be a debt ceiling. We just have to figure out a way to live with it.
Well, this year is not showing us that we're any closer to figuring out a way to live with it, Vince. Finally, I do want to circle back to the Fed for just a moment, because I'm curious how, if at all, this whole debt ceiling mess, is going to inform what the Fed is going to do.
Okay, it's a really simple construct. Absent distracting drama on the debt ceiling or banks, if the Fed gets a trifecta of strong data, the economy's economic activity has momentum, resources are stretched, and inflation continues to be stubborn, then they'll raise rates. So the debt ceiling matters for the next couple of weeks. From the Fed's perspective, if it's hanging out there, it's harder for them to act. If it goes away, then they can focus more on what they really want to focus on, and that is the incoming economic data. I'm not sure what they're going to do at the next meeting. You read the minutes that were published yesterday, they're not sure either. There's heightened uncertainty. This is one of the times you can legitimately say policymakers are looking at the incoming information. There's good news, though. They so hate surprising markets, they'll let us know what they're going to do at least a week before the meeting.
That is a very good reminder. Vincent Reinhart, good to catch up with you. Dreyfus and Mellon Chief Economist. Thanks a lot. Appreciate it. Let's take a look at some trending tickers that we are watching. A tale of two retailers. American Eagle shares, they are plunging some 17% this morning after it slashed its full-year outlook, citing slowing sales, a stark contrast from what its competitor Abercrombie & Fitch reported yesterday, remember. But on the flip side today, we're also watching Ralph Lauren. Those shares are up 8% after the retailer saw a surprise rise in its fourth quarter revenue, getting a boost from recovery in China, where it saw sales rise over 30%. So very interesting what we've seen in the results over the past few days is that there is not this sort of monolithic discretionary is doing well or is doing poorly and staples are doing well. It's a bit more murky than that. Coming up, why our next guest is touting optimism for the U.S. economy. We'll speak with BlackRock's Rick Reeder next. Let's do a quick check of the markets now, sponsored by FlexShares. As we've been talking about, we see a divide in the market today. The Nasdaq being driven higher by Nvidia, up 1.2%, and the S&P 500 also catching a bid, up about 0.5%. But the Dow being dragged lower by energy, for example. It's off by about 1/5 of 1%. And as we just mentioned, a tale of two indexes and two big stories driving both this morning. The Dow having another down day so far. A negative close would be the fifth in a row as debt ceiling talks look for traction, and Fitch puts the U.S.'s AAA credit rating on watch. Then on the flip side, there is the Nasdaq, storming higher on an eye-popping beat from Nvidia, for many the clear leader and main beneficiary of the AI boom. The bond market, on the other hand, also responding to the uncertainty from D.C., plus the Fed's next meeting, for that matter, with yields up across the curve. Let's make sense of it all with Rick Reeder, BlackRock Global Fixed Income Chief Investment Officer. And Rick, congrats, recent recipient of the 2023 Outstanding Portfolio Manager Award for Morningstar. In other words, people should listen to you, I think, is the bottom line. Thanks for being here. I know you made some public comments recently where you talked about your relative optimism about the economy. And it seems like we have kind of a lot of things coming at us at once, from the debt ceiling to whatever the Fed's going to do to some of the retail results that we've gotten. Then you got Nvidia on the other hand. How do you synthesize all of that and say the economy's okay?
So when you break down the component parts, if you look anecdotally at data, and you could say, gosh, I saw, rough, by the way, if you look at surveys, and I think the markets overestimate surveys. They tend to move with sentiment like the equity market. But if you look at hard data, and if you think about where we stand today, you've got an unemployment rate of 3.4%. You've got wages at over 4%. They just revised up the excess savings in the country. I think it's now 1.9 trillion. You look at the consumer, like you were describing earlier, consumer pulling back in some areas, being a bit more prudent. There's some disparity in terms of lower income, higher income that's going on there. But if you break down the component parts and you think about, you've got a consumer that's in good shape, then it's spending. You've got construction in this country that continues to be durably strong. You certainly see it from things that come on the backside of the IRA. You certainly see it. Actually, home building, you see some of the home builder results has actually been solid. That's a big component, and that's actually doing well today. You're going to get some investment in CapEx, in hard CapEx that's going to come down. But then you've got this technology spend that is in real CapEx dollars. So when you break it all down, you look at the component parts, economy's actually in pretty solid shape today. So listen, if you said to me one thing that is trickier is inflation is we have an economy that's in good shape that's slowing. It's not slowing. I think the argument we're definitely going to recession, I think, is dubious. The question is, can inflation come down enough to hit the Fed's target? And that's the one that it's not clear at this point. I mean, inflation is stickier than I think a lot of people thought heretofore.
So you talk about one headwind, Rick. Diane here, by the way. Hi. So I got to ask you about another one that's immediately top of mind right now, and that's the debt ceiling debate that's happening. Mm-hmm. We've been here before. Markets don't seem as rattled this time around as they did back in, say, 2011, and when you had the S&P downgrade the U.S. credit rating, never restored it. Now Fitch threatening to do that now. Should the market be taking this be more nervous than it is?
So I think the markets is taking the statements that are coming out that there will be an agreement, that the U.S. is not going to default on the debt. I think the market's taking that to heart. And like you say, has generally written off that we're going to have some tumultuous disruption in terms of the debt. Do I think that's right? I generally think that's right. I think the one thing that is important, and I think people need to think about, is the more that the government feels the need to continue to do this and have this debate. The dollar. We live in a world today where it's different than it used to be. The dollar was always the flight to quality. Let's go into dollars if there's any risk. The world is changing. Deglobalization, post-sanctions, et cetera. So it's something that I watch quite a bit. Quite frankly, I've been investing more in emerging markets because I think the persistent rally of the dollar that we saw last year, I don't think you see that again. And, the emerging markets give you an awful lot of yield, and the growth in some of the emerging markets areas is pretty generous. So that, to me, is the part that, we're spending some time on. But listen, by the way, it's not done. If they come out of a room and say we have an agreement, you still got to go through votes. And so it's not done. I think one thing when you say, people are generally not long the equity market. And certainly high frequency players are not long the equity market. What is happening is people are long an immense amount of cash. I mean, I haven't seen anything like this in my career. There's almost $6 trillion sitting in money market funds. The money keeps flowing in. because people are, gosh, I want to sit back and wait, and you're getting paid to wait. I mean, these yields. I mean, you talk about Treasury bills yesterday got to behind 7% for that short maturity. But generally you could buy Treasury bills in and around 5. You're getting paid to sit in cash, and that's where people are pulling back and saying, I'm going to hold a large cash position.
And it doesn't seem like necessarily that even this debt ceiling situation would change that. I mean, we've been talking a lot about 2011, right? And even after the debt ceiling crisis was averted, the S&P downgrade came, and people still bought treasuries, right? Are we going to see, even if the most dire predictions come true, are we going to see a similar pattern this time?
Yeah, I think people are comfortable that even if you have some breach and some form of default, that you're still going to get paid, and that, gosh, there are not a lot of alternatives in the world that are as safe as treasuries. People will feel comfortable being in treasuries. Could you have, and that's part of why you're seeing, I've never seen the spread between in literally a week's term in terms of different maturities of treasury bills. There were treasury bills, really short-end treasury bills yesterday trading at 2.5%, and the ones right after the June 1 date were trading at over 7. So people are like, I'm going to manage that. But I think generally people feel good about owning treasuries. And listen, I think you would take the government at the word that you're going to pay, they will pay principal and interest. And I think that's right. You think about the ramifications of not. Treasuries are the collateral for the way global commerce works. Dollar is a reserve currency in the world. How we build every asset valuation in the world, debt, equity, everything, or certainly on any U.S. asset, is based on, I got to know the risk-free rate. Once I know the risk-free rate, I can then start taking my decisions around what return hurdle do I need for other assets. Once you breach that, that's chaos. And I think government officials understand the ramifications of that.
Rick, I want to narrow the focus just a little bit. You all launched a new actively managed ETF. What is the plan for that? How do you all plan to or expect to beat the market?
I mean, there's a couple of things that play around that ETF. One is the receptivity of the marketplace to ETFs these days. They go into models that people easy access, easy exit and entry in terms of them. And the one we've structured with, they're going to put a generous income on it. We're targeting a yield today. The yield is almost 7%. Using diversified. In fixed income, it is hard for people to say, "Gosh, should I buy this part of the high yield market? I'm going to take some securitized assets, which I buy agency mortgages. I want safe securitized assets." Those are hard. Emerging markets, where do I buy? One of the things that we think is really attractive of this, it diversifies, it creates a lot of yield. Talk about getting a 7 and you can get in and out. We think we've already seen an awful lot of excitement and enthusiasm around it. And so we're going to try and manage it to a generous yield for people, but diversify it, try and create balance, get a lot of yield, but then create some balance in the portfolio. And I think fixed income's harder to do that than parts of the equity market, because it's there are thousands and thousands of securities in fixed income. And we try and help manage that for people in what is an efficient wrapper and liquid wrapper that you can manage around.
Yeah, I'm just looking at some of the holdings in here. We were showing some of them, Rick. And it's a big ETF, right? There's a lot in there, to your point about there being a lot to choose from in the fixed income market. It's interesting to me, you were just talking about emerging markets a moment ago, and you do have some emerging market sovereigns in there. I'm looking at Indonesia, I'm looking at the Czech Republic, et cetera. Talk to us a little bit more. You touched on that earlier, why those areas might be attractive right now. Talk to us a little bit more about that, especially in the face of that dollar strength.
Yeah. So first thing, emerging markets I've learned over my career, you've got to be careful and you've got to diversify them. So you'll see in any of those holdings, they're not very sizable holdings, but you look today, 2-year Mexico, you're getting paid 10%, behind 10%. Mexico, you talk about deglobalization. Where is investment going to go in the future? Where is the U.S. relationship going to be with China relative to the partner next door? It is going to be a growth engine, and the yields you're getting paid. Also, parts of the EM, Mexico, Brazil, they started raising rates faster. They got the inflation issue. EM is used to excessive inflation. They get at it quickly. They got at it quickly. Now they're at a closer point where they could start bringing rates down. And that, from a fixed income investor, you want to be on board the train when they're bringing rates down. So and you're getting paid to be there. And there's another part of EM today that's attractive. Is you can benefit from, again, you got to manage the risk, but you can benefit from those yields coming down and being generous today. and their currencies can improve. And you're seeing that it's certainly played out. Mexico has been extraordinary in terms of how much the currency is improving. And I think it's part of that where we feel good about where they're going to be longer term in the geopolitical sphere. So anyway, like I say, I don't think, and we're never going to overdo emerging markets in a fund like this, because listen, EM is always subject to change in global growth dynamics, but to diversify, get in the right parts of EM, or at least what we think they are today, I think is a good way to manage it.
Yeah, and EM certainly also has to deal with certain political issues in certain countries. And Rick, one unrelated question to all of this. Did you still get up at 3:45? Do you still get up at 3:45 in the morning?
Yes, ma'am.
Okay, you beat me.
That
you
is,
beat me.
I have a Whoop band that measures your sleep and measures
How much
the time
sleep
you get up.
Do you get?
I get a little over 4 hours a night,
okay.
but I'm
right.
got a lot of energy. There's a lot to do.
Doctors may have something to say about this, but
I
I'm not one.
that.
All right, I'll leave it there.
But he always brings the energy for us.
Exactly.
So
always
love
the
it.
energy. Clearly well caffeinated as well. All right. Our thanks to Rick Reeder, BlackRock Global Fixed Income Chief Investment Officer. Meantime, coming up, Abercrombie shares are coming back down to earth after yesterday's surge. We'll share our interview with the retailer CEO. That's next.
Abercrombie shares are pulling back slightly today after surging yesterday on the retailer's surprise profit and raised full-year guidance. Yahoo Finance executive editor Brian Sozzi caught up with Abercrombie & Fitch CEO Fran Horowitz yesterday to discuss.
Super exciting day here on campus, Brian. It's great to see all of the smiling faces and all the energy that we have going here. Abercrombie particularly up 14%, which was growth on top of last year's 13%. There's so many exciting things happening in that brand. I'm trying to figure out where should we even start?
Go with cargo pants.
Start with cargo pants. Okay. Cargo pants are important, but what's really exciting about Abercrombie is that we've really changed the brand from what people used to reference as a t-shirt and jeans brand to a lifestyle brand. And the consumer is coming to us for so many more categories today, which is really what's driving the momentum in our business. You know, the turn started a couple of years ago with the women's business where we got that going first. Now our men's business is also very good. Our third consecutive quarter of growth for men's, 11th consecutive double digits for women's. But we can talk about all sorts of categories. Dresses all day long. She's coming to us for all sorts of occasion dressing. The men, guys and girls are both coming to us for pants. That's a fun conversation because that's kind of a new trend to this consumer. Now that they're back at the office and they're trying to figure out what to wear to work, they're coming to us for that as well. So lots of exciting things happening.
Fran, you must have read my notes. And as you know, we've known each other for a while. I'm an avid earnings call listener geek. I love earnings calls. And to that point, I love what you mentioned on the call about people going back to the office. And is Abercrombie & Fitch, that brand, is that the new wardrobe? And I mean, what are people wearing to the office again?
Isn't that exciting though, Brian? I mean, to your point, right? People never thought of us as an opportunity to go back to the office, and now they certainly are. They're probably not necessarily wearing suits to the office, but they're certainly wearing something more dressed up than they were doing during the pandemic when they were working from home. So our pant business, our non-denim business is just off the charts. We've got a franchise in the women's business called the Sloan pant. You see it all over TikTok. We keep producing it in all sorts of fabrics and colors, and she loves it time and time again. And in the men's business as well, we're selling trousers and pants that they can wear to the office.
This is a major fundamental shift in the economy and society, people going, humans back in some form of office setting. Look at me, I'm back in the office here at Yahoo Finance every single day, and my wardrobe is in fact changing beyond the suit that you're wearing now. I mean, as a merchant and heart, Fran, does that change how you plan your assortment in the back half of this year? Should we see more wear-to-work apparel from Abercrombie & Fitch?
Well, I think a couple of things. I think, first of all, to strike a balance in your assortment is the most important thing. Everybody on campus knows my favorite word is balance, and just making sure you don't ever lean one way or the other, because even with people going back to the office, Brian, they're probably not going back 5 days a week. They're probably going back, 2 or 3 days a week. So there's an opportunity for us to service them on the more casual days, as well as those days where they're back in the office.
I thought the customer that shopped Abercrombie & Fitch, and we'll talk about Hollister too as well, I thought they were economically challenged.
We have been seeing a very strong consumer on the Abercrombie brand all through last year and certainly through the first quarter. We're also very pleased with our kickoff to the second quarter. So we have not experienced that. But what I will tell you is, the customer has a choice on where to shop, and they're choosing us because what we're doing is working.
What about the state of the Hollister business? I know you continue to try to round the corner for that brand. What may be holding it back? Because sales were under pressure.
Yes, so it's interesting. I'd love to take you on that journey for Hollister. So last year during the second quarter, we saw a step down, just like a lot of the other teen brands did as well. But what we did was we said, how much of this is us and how much of this is macro? And we found some opportunities for us. So we've been on a journey to really evolve our assortments and get back to being close to that customer. We've worked on our assortment architecture. We've worked on our assortments. And what we're seeing is, as we've pivoted, out of being predominantly denim, as an example, non-denim bottoms again are working. Dresses are working. So the top line was disappointing, to your point, but the bottom line wasn't. So we're back to profitability. We actually were able to raise our AUR, which is a good sign that the brand is healthy. And most excitingly is our inventory is under control. So we're down 20% as a total company, and even more with Hollister. That has brought back one of my other favorite words, which is chase. And the fact that the team can now chase goods and react to the business is a big win for us.
Well, okay, maybe some green shoots in Hollister, Abercrombie & Fitch brand firing on all cylinders. If you had to place a guess, how do you think the key back-to-school shopping season will go for your company?
I'm looking forward to back to school, especially since we've evolved all the assortments. So we'll start to see, the end of Q2 and third quarter, we'll see. But I'm looking forward to it, and I'm excited about what we have for the consumer.
We've heard a lot of retailers call out this earnings season. Consumers are trading down. Are you seeing that in your business?
We are not seeing in it. We've seen AUR increases, interestingly enough. We came out of the pandemic. We have had double-digit AUR increases through 2020 from pre-pandemic. That is something we tried to do pre-pandemic for many years and couldn't accomplish. Our goal coming into 2023 was to hold on to those AURs. And in fact, we beat them for Q1 and in both brands.
I know we have talked many times through the years on how you continue just to close underperforming stores. You're opening new stores, but given all the concerns in commercial real estate with interest rates, are you getting any higher rents? Are some of these mall players trying to raise rents on you because of challenges they are in fact seeing?
I mean, we have two very strong global brands, so we are very desirable in the malls. To your point, that we've been on a stores journey for a very long time. You know, it started with a lot of closures, and now we're being back to a net store opener. So in 2022, we were net store opener. We plan to be one again for 23. But the most important thing for the team is to make sure that we find stores that are the right size, the right location, and the right economics, and we don't budge on that. So if the deal doesn't work for us, we pass and we patiently wait until we can get the deal that does work for us.
How do some of these newer stores you're opening compare to the stores that are already in the ground, whether it be Hollister or Abercrombie & Fitch?
So both are much smaller. You know, what we have found is that these smaller, more efficient formats are definitely working for us. Some exciting new things that we're doing in Abercrombie is that we're opening up street locations. We opened up a couple in Chicago last year that have been absolutely terrific. We just opened one up on Newbury Street in Boston. We have a few more planned for the balance of the year in some key cities. So again, you know, listening to the customer and understanding where our consumer is, we're always testing and learning and trying to find new opportunities.
One thing we have been tracking here closely here at Yahoo Finance, Fran, in retail is inventory shrinkage or theft. Does this apply to your business? And then what are your contacts saying in the industry? You know, I talked to the folks at Target. They're calling out a $500 million profit hit this year because of theft. I mean, do you see that in your stores? And have you had to put extra security in your locations?
You know, we've been very fortunate. At this point, our P&L, we always have to reflect some shrink because it's all part of, you know, of what we do. But we have not seen a spike in it at this point.
That is certainly a good thing to hear. And I will, last question for me here, Fran. What is the biggest challenge you're up against this year as a leader? We have concerns about a debt ceiling. We have inflation that seems to be benefiting you a little bit. That's starting to come down. That's a good thing. But you know, how do you think, as you try to formulate your plan for the back half of the year, what are some of the things you're up against?
Yeah, I guess when I step back, Brian, I think about the last 3 years as a CEO. Anybody that has sat in this seat is honestly ready for anything and everything that comes at us. It's taught us how to be incredibly agile and really ready to pivot on any opportunity. So there is a lot out there, to your point, a lot of macro things that we're not sure about, but we're ready to compete. We've got our inventories under control and we're controlling what we can.
That was Abercrombie & Fitch CEO Fran Horowitz, along with Brian Sozzi. Coming up, Best Buy shares are in the green despite falling comparable sales and a weak outlook for electronics. So why are investors still optimistic? We'll tell you next.
Shares of Best Buy on the rise this morning, despite missing sales estimates and forecasting weaker consumer spending to come this year on electronics. Anthony Chukumba, Loop Capital Markets Managing Director, joins us now for analysis. So, Anthony, let's get right into Best Buy first. And we do also want to talk Dollar Tree, but let's start with Best Buy today. What's your initial take of the results?
My initial take was that these are certainly less bad than feared. I mean, look, comparable store sales did decline 10%, so that's not great, but operating margins were a little bit better than we expected. Our earnings were a little bit better than we expected, and management reiterated their guidance for the full year. In addition to that, they did say that comp store sales trends improved sequentially so far in the second quarter, and they did say that they expect this year to be sort of a bottom in terms of consumer electronics demand. So there were certainly some positive things that we heard as well.
Hey, Anthony, it's Julie here. I also saw inventories, I think, were down about 16%, so an improvement there like we've seen from a lot of the other retailers. Does that mean also that Best Buy is not necessarily having to slash prices as much and offer as many discounts as it did before to try and clear the stuff it wasn't selling out of there?
You're 100% right. I mean, they've kept their inventory levels very, very lean. They didn't necessarily have the inventory problems that we saw from a lot of retailers in 2022, and so that's certainly a positive. I mean, the last thing you want to have when demand is softening is too much inventory, because inventory is not like wine; it does not get better with age.
Anthony, so you all do a price comparison of Best Buy compared to Amazon. Does Best Buy, are they nailing pricing now, or do they need to work on that more?
They are 100% nailing pricing, and they've been doing that for quite some time. So what we have found for the last several years, quite frankly, is that they're pretty much at price parity with Amazon. I mean, occasionally you'll find some small differences here and there, but nothing material. In addition to that, Best Buy will price match Amazon and a number of their other large competitors, by the way, at the point of sale. No questions asked. I've actually done it several times. So, they are not allowing Amazon or anyone, for that matter, to undercut them on price.
Anthony, let's switch on over to Dollar Tree here, because this is an interesting one, right? There was this assumption going in that they would benefit from a trade down effect. It seems like maybe they did, but people are buying a lot of food items, which are lower margin for them. Is there anything they can be doing to sort of managing around the situation here that you think that they're not?
Yeah, that's a good question. I mean, look, in terms of the mix, as you mentioned, to consumables, which are lower margin, there's not a whole heck of a lot they can do about that. Now, the one other thing that really impacted them that was a real surprise was shrink. I mean, look, a lot of retailers have been talking about shrink and how shrink has increased. They hadn't been as vocal about that, and that is something that they can and I think will do more to control going forward. But in terms of that mix shift, not a whole heck of a lot they can do. And quite frankly, look, I was very encouraged by the comparable store sales increases in both Dollar Tree, which, remember, was anniversarying that price increase from $1 to $1.25. So the fact they could comp positive on top of that is very encouraging. And then Family Dollar, which has been the redhead stepchild, the problem child, we saw comp up almost 7%. So clearly the investments that they're making are working in Family Dollar.
So, well, in Family Dollar, fine. But going back to Dollar Tree, again, the stock taking a big hit today. The numbers were worse than expected. And they, again, yes, they talked about shrink, but what went wrong here? I mean, you would think that Dollar Tree would hold up strong in the face of an inflationary environment. What stood out to you as to what went wrong?
Yeah, well, let's just clarify. Family Dollar is owned by Dollar Tree, so it's the same company.
Right.
But yeah, I mean, look, I think that there was clearly an expectation that with Mantle Ridge having taken control of the board last year, with Rick Dreiling, who executed the amazing multi-year turnaround at Dollar General, that we would be further ahead in the turnaround, right? That we would see much better, not only top-line results, but profitability results, and we haven't seen that. Now, we have seen the top line improve, and that is very, very encouraging, but profitability continues to be pressured, and I think that there are probably some investors that are losing faith, that are wondering if Rick's best days are behind them, and quite frankly, I think that's a legitimate concern, given the numbers that we've seen. Now, my response to that is that, look, I mean, turnarounds, they can be lumpy. It's just not always kind of, straight into, upward and to the right. And I think that that we need to give Rick and the team more time, quite frankly.
Anthony, you have a pretty big coverage universe, and it's a lot of different diverse retailers, from staples like a Dollar Tree to more discretionary like a Best Buy, also Williams-Sonoma, Dick's on the list. Two questions for you on that general front. Firstly, on the issue of shrink, how big of a problem is this for the broader retail industry right now, and how are they getting their hands around it?
Yeah, great question. So it's interesting. We actually hosted a call with a longtime shrink expert earlier this year, and it's a problem. There's no question about that. And it's impacting a lot of retailers. We're seeing a lot of retailers talking about increased shrink. Now, there are some things that retailers can do about shrink. So, for example, you can see them put more items, behind fixturing, where essentially you have to call someone over to open up the item. That's not great from a customer experience perspective. That can certainly work. You might see them add security guards into the stores. Dollar Tree was talking about in Family Dollar, they might even selectively raise prices in areas with high shrink. But to some extent, it's very limited in terms of what you can do. I mean, a lot of it is going to have to come down to local governments enforcing sort of shoplifting laws and cracking down on shoplifters and organized retail crime, and we're just not seeing that.
Yeah, definitely not. Obviously, it seems like it's still just this big problem for them. And then just more generally, too, about consumer spending right now. I mean, as I know not everybody in your coverage has reported as of yet, but from what we've seen thus far, what is distinguishing those that are doing well and those that are doing not as doing as well in this sort of more choosy customer environment?
So, I mean, certainly what we're seeing is that retailers that sell more kind of consumable items, right? Think food, health and beauty care items, cleaning supplies, essentially necessities, are generally doing better than retailers are selling discretionary items, particularly high-ticket discretionary items. And a lot of that has to do with these macroeconomic headwinds, and it's still very, very uncertain. And in addition to that, remember, we had, 2 years of pandemic, driven demand pull forwards in a lot of those high-ticket discretionary items. But having said that, it still is, it's very kind of company-specific, right? So you had, Foot Locker and their, horrific blow-up last week. But then you had Dick's Sporting Goods, who I cover, and they had a perfectly fine first quarter. So, the retail industry, I say it's pretty much always a stock picker's market. You just have to kind of roll up your sleeves and do the work, because while the rising tide does lift and lower all boats, a lot of it has to do with, company-specific, situations and strategies and management teams.
All right, we will have to leave it there, Anthony Chukumba, although I do want to hear your forecast, because I know you made one in 2022 about Bed Bath & Beyond that came to pass, but we'll have to wait for the forecast of what nail in the coffin is coming. Our thanks to you, as usual, Anthony Chukumba, Loop Capital Markets Managing Director. Coming up, as consumers digest Netflix's password sharing crackdown, how are analysts feeling? Our own Ali Canal has the details. That's next. Well, it's been a few days since Netflix's password sharing crackdown hit the U.S., and the street has been talking. Here with what analysts have to say about the new rules and impact on the streaming giant is Yahoo Finance reporter Alexandra Canal. Allie?
Yes.
Let's see what the analysts are saying.
Well, as expected, analysts are pretty optimistic over this rollout. We had Oppenheimer reiterating their outperforming. They also raised their price target to $450 a share, up from the prior $415, and that implies upside of 25% from current levels. So a lot of potential there. Oppenheimer also conducted a survey with nearly 2,000 Netflix users, and based on those results, found that Netflix could add 36 million new subscribers over the long term. On top of that, the survey results indicated that about half of current Netflix users that were either kicked off of the plan, have to sign up for new plans, they would subscribe to that ad-supported tier. We know how important the ad tier is when it comes to streaming profitability. So ultimately, Oppenheimer is saying that future consensus estimates are not accounting for the potential of ad tier as well as the clampdown on password sharing. I also spoke with CFRA analyst Ken Leon, who said there's an opportunity for Netflix to really build a loyal subscriber base and that this was a long time coming. He said there will probably be a few choppy quarters from a financial perspective, but then once we hit Q4, Netflix should be in a really strong position and set it up really well for 2024. So it's going to be an interesting few quarters, especially as Netflix reports, and we'll see how much they can gain from both ad-supported and that password crackdown.
Yeah, we're no chill.
Yeah. All right, another major player in streaming is Hulu. According to the Wall Street Journal, the battle between Disney and Comcast for ownership is heating up.
This was a very interesting report from the Journal, and it really dove into the drama surrounding both Comcast and Disney that dates all the way back to the Fox acquisition. But what stood out to me in this piece in particular is the discrepancy over the valuation of Hulu. In 2021, according to this report, NBC Universal said that Hulu was worth roughly $70 billion, but that Disney had a valuation that was tens of billions of dollars less than that. So under the current agreement,
because it wants to buy the rest, so it's trying to get a bargain.
Exactly. So to me, if there's that, intense of a discrepancy, that's going to be a problem down the line. Now in 2024, that's the deadline, January of 2024. That's when we'll really determine. These estimates are from 2021. They're going to reassess in 2024, and if they can't reach some sort of an agreement, they're going to enlist a third-party entity to come in and try and determine the true value of Hulu. Now, under the current agreement, Hulu would be priced at a guaranteed minimum equity value of $27.5 billion. So that's the minimum. Comcast CEO Brian Roberts says it's more than likely it's going to sell for more than that. But again, both sides have to reach that agreement. So that was the most interesting part to me. So the battle for Hulu, not quite over yet.
No, it sounds like it's going to go on for quite a while. Thanks so much, Allie. Appreciate it. All right, let's do a quick check of the market sponsored by Flex Shares here, almost 90 minutes into the session. And we see things holding relatively steady here. The Nasdaq, once again, is the leader today, due in large part to Nvidia and semiconductors. The S&P gaining, but the Dow is down. Coming up, how the U.S. can resolve the debt ceiling debate without risking default. Is it possible? Rochelle Akufo is going to speak to Hoover Institution fellow Lanny Chen. That is next.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. From strength to strength, Nvidia blows past even the most bullish of expectations with first quarter earnings and guidance as demand for AI chips rockets. We ask a portfolio manager for their take on the AI craze coming up. And optimism from the House Speaker that a deal will be reached on the debt ceiling isn't enough for Fitch. The ratings agency places the U.S. on ratings watch negative. We get the White House's response coming up. And it's the backbone of America, but is it feeling confident? We catch up with American Express as it launches its first ever small business financial confidence report. Don't miss that conversation coming up this hour. But first, let's take a look at the major indices here. A mixed picture here, only the Dow in negative territory there, down by 54 points as that news from Nvidia lifting all boats for the S&P 500, with tech the strongest performing sector there today. And also, of course, that's also lifting the Nasdaq as well, up 1.45% so far. Let's also check in on the Treasury market as well. We see the shorter term yields there climbing about 1.4% there. The 10-year also up about 1.3%, and the longer term 30-year yields up just about 0.4% there. Still waiting for the outcome of those debt ceiling talks. Well, the pressure to secure a debt limit deal is getting more urgent as credit rating agency Fitch puts U.S. debt on rating watch negative. Well, joining us now with some insight on this is Yahoo Finance reporter Jennifer Schonberger. So, Jennifer, what has been the White House response to this?
Good morning, Rochelle. That's right. As Republicans and Democrats struggle to strike a deal to raise the nation's borrowing limit, Fitch Ratings has put the U.S.'s pristine credit rating on downgrade watch, conjuring up memories of 2011 when the nation's credit rating was downgraded amongst similar brinksmanship, touching off a stock market swoon in higher interest rates. The White House saying in a statement this morning, quote, "This is one more piece of evidence that default is not an option and all responsible lawmakers understand that." Meanwhile, Treasury saying in a separate statement this morning, quote, "As Secretary Yellen has warned for months, brinksmanship over the debt limit does serious harm to businesses and American families, raising short-term borrowing costs for taxpayers and threatens the credit rating of the United States." Secretary Yellen said Wednesday that it seems almost certain the U.S. government will not be able to pay its bills past early June, saying, quote, "We no longer see very much likelihood there are resources that will enable us to get to the middle or end of June." Yellen says there are early signs of stress in financial markets already, pointing to much higher yields on Treasury bills coming due in early to mid-June. Yellen noted that in the debt ceiling showdown during 2011, the U.S. paid an estimated extra $1 billion in interest payments just during that year, and that interest payments remained higher for a bit longer despite a deal to raise the debt ceiling in the 11th hour. Now, meanwhile, minutes from the Fed's last policy meeting show officials think they need to be ready to deploy liquidity and regulatory tools in the event that the debt ceiling is breached. Rochelle?
And speaking of the Fed, you also have some Fed speak for us from Boston's Susan Collins. What have you heard there?
Yeah, Rochelle, Boston Fed President Susan Collins speaking this morning in Rhode Island, saying that she thinks the Fed may be near or at a point where it could pause raising interest rates, citing a moderation in inflation. She thinks this is going to allow the Fed to kind of take a step back and see how the 10 interest rates that the Fed has already done over the past year permeate through the economy, while also taking into account the credit tightening we're seeing on the back of those recent bank failures this spring. Michelle?
All right. Thanks for getting us up to speed. Jennifer Schonberger there. Thanks so much. Meanwhile, Meta stock moving to the upside today. The company beginning its latest round of layoffs, and former employees have taken to LinkedIn to announce that they've been laid off. Yahoo Finance tech reporter Ali Garfinkel here has the latest. Now, Ali, you've spoken to some of these former employees. What are they saying?
Hi, Rochelle. So you're right. I've actually been chasing around a number of these employees for the last 24 hours, really trying to get a sense of what happened, how it happened. And the message I'm getting from them is that even though this is officially the last round of layoffs that came from the plan that started back in March, this was pretty brutal. And in part, it's because there were cuts in areas that were previously thought of as essential. Areas like marketing, user experience, engineering, whole comms teams slashed in half or almost completely. I've also confirmed with a couple of people that Reality Labs was affected. Engineers in hot areas like AI were affected. And even managers were affected in what internally some people have been calling the flattening. Though it's kind of a coy joke, a lot of employees described a company that's in the midst of a massive cultural change. That cultural change did start back last year when COO Sheryl Sandberg, now former COO Sheryl Sandberg, left the company. And what they've said is that the company has become more tense. It's become more openly competitive between groups. And it's also become more impersonal. One worker told me that these cultural changes are encapsulated in how he was laid off. This is what he said to me. I woke up in the morning and saw the email. My manager reached out to me, but refused to get on a Zoom call with me, saying we should email. I could never imagine that happening when I joined a year ago. This made me feel better about being done with Meta, me thinking, wow, maybe I don't want to be a part of this. Rochelle, the markets have rewarded Meta's cuts, right? Stock up more than 100% year to date, cutting at least $10 billion out of the company's expenses forecast. But a lot of these conversations, for me at least, have left me thinking that Meta is perhaps changing permanently.
It's interesting because it started out as this year of efficiency, and now you're not really sure what the longer game is here. And obviously, stock price is being rewarded, but looking at the human beings behind this. So then, is this the end of Meta's layoffs necessarily?
That's tricky, isn't it, Rochelle? Because you're right. It is the year of efficiency. It was the year of efficiency. It still remains, as far as I can tell, the year of efficiency. And though officially, for all intents and purposes, from what I know, from what everyone I've spoken to knows, this is the end of Meta's layoffs. However, I think we can't overestimate how much these expenses have helped Meta in the public markets, how much they've helped its image on Wall Street. So my take, and this is just my read, I think if they had to do more layoffs, they absolutely would.
Especially as they step up their AI capabilities as well. Be interesting to see where that goes. Ali Garfinkel, thank you so much for that update. Well, the Wall Street Journal is reporting that Dish Network is in talks to sell its mobile phone service through Amazon. The stock is surging on the news, up almost 10% right now. An announcement could reportedly come as soon as June, which is also when the company must meet new 5G coverage milestones or be fined by federal regulators. Dish Network stock has been struggling, down over 50% year to date as it loses market share in television to streamers and attempts to become a major player in the wireless business as well. All right, coming up, a new report out from American Express dives deeper into the state of small business. That's a Yahoo Finance exclusive coming up soon. But first, more than 60% of Americans own stocks, the highest level since 2008. More on what's behind that rise coming up next. Let's do a quick check of the market, sponsored by Flex Shares. Still looking at a mixed picture here, as the S&P 500 and the Nasdaq still the beneficiaries of what we saw from Nvidia's earnings call and that exceptional forward guidance there. We see the S&P up about 0.8% there, the Nasdaq up 1.6%. The Dow, though, still under pressure, but some of that selling action slowing down there, down about 44 points. Well, the majority of US adults have some skin in the stock market game. That's according to a new poll from Gallup. 61% of Americans own stock, a level not seen since 2008. Stock ownership plunged after the 2007-2008 recession and remained muted, at least until now. Here to break down the data is Yahoo Finance reporter Kerry Hannon. Good to see you, Kerry. So what's happening here? Why are we now seeing this change?
I know, it's really quite interesting, isn't it, Rochelle? What Gallup found is, these numbers really have popped up, and there's a couple of good explanations for this. The number one reason is, there are not a lot in the last year or so, there haven't been a lot of alternatives to investing your money, right? I mean, fixed income, CDs, money markets were 1% or below. I mean, it was really nowhere to go. So people stayed invested. That's one reason. There just wasn't another alternative. A second reason is quite simply employment has been quite high. And after the Great Recession, when everyone fled the market, even though we had the worst market, right, the sinking market was probably I think it was the worst year since 2008. And in 2008, everyone left the market. But this time they stayed in because of this lack of other places to go. But also, I think a lot of it was the high employment. People were continuing to work. And what that means is you have access to an employer retirement plan. So you're kind of forced to, it's almost like automatically you continue to add to your portfolio and out of sight, out of mind kind of thing. And it really has kept people in the market. An interesting thing is also boomers tend to be working longer. And that was a big takeaway from this study. And today, actually, Fidelity came out with a report I just saw that showed in the first quarter that the cohort of savers that were saving the most money in Fidelity's accounts were boomers. That's because they're still working, they're saving, and they're eyeing longevity, right? They have long retirements ahead of them if they were to step out now and stop saving.
Lots of great insights there to keep track of. Great stuff. Thank you so much, Yahoo Finance reporter Kerry Hannon.
Thanks, Rochelle.
All right, well, taking a look at small business. Small business confidence dropped in April to 89, the lowest level in more than 10 years, according to the NFIB. Owner pessimism driven by a looming recession and worker shortages. Now, American Express took a deeper dive with its first ever small business financial confidence report for a better understanding at broader influences weighing on smaller shops. I'm joined now by Anna Mars, Group President of Global Commercial Services and Credit Fraud Risk at American Express, alongside Yahoo Finance's own Diane King Hall in a Yahoo Finance exclusive interview. Thank you so much for joining us this morning. Congratulations on this report. Of course, thank you. So talk about this deeper dive that we get from Amex's new report versus what we would get from the NFIB.
Okay, absolutely. Well, we all know small businesses are important, right? They provide about half of all the jobs in the U.S. economy. We see small businesses today as navigating kind of twin peaks. On the one hand, they're recovering from a pandemic, from supply chain issues. And on the other hand, they're preparing for a more uncertain macro environment. And so what we found in the first American Express Small Business Financial Confidence Report is a lack of financial confidence in small businesses. So we found that around 50% of small businesses feel truly confident when taking financial decisions. And that number falls even lower to the smallest of small businesses. Only 29% feel financially confident. And this has a real impact. In fact, 40% of the businesses in this study said that they didn't take growth opportunities on the back of a lack of financial confidence.
So one of the things that may not have been pulled out in this, but it's top of mind right now, does it come up when you're talking to small businesses about the debt ceiling? Are they worried about the debt ceiling?
Well, it's certainly in the news. We all see it in the news. American Express, we don't employ economists, but we all look at these reports and the news that's underway. There's no doubt that a shutdown of the U.S. government would be another shock on the U.S. economy, and there's yet another thing for small businesses to have to navigate. And so absolutely, it would play into something like the optimism report that Rochelle talked about at the start of the segment.
Right.
And Anna, obviously we're in an environment, you have high inflation, but you also have tighter lending conditions that stem from some of the banking fallout. How are some of these smaller businesses managing cash flow?
It's directly related. Small businesses, cash flow is the perennial problem. It's actually true the world over. Understanding the money that's coming in, the money that's going out, contributes to their lack of confidence. And when credit gets tight, clearly cash flow gets tight. And so at American Express, that's been a big focus of us. How do we get small businesses to have more transparency into their cash flow? We actually created a whole digital hub called the Business Blueprint. Small businesses, any small business can go on, get a login, link in their bank accounts, and see their cash flow. So what's coming in, what's going out. They can access an easy-to-access line of credit if they want to augment their financial position, and really make sure they do have that confidence to take those growth opportunities, which will help grow our economy, as well as their business, and give them what they need to thrive.
And I want to ask you about jobs in particular, because as you mentioned, small businesses account for a great chunk of the job market, and the job market has been very resilient in recent months, especially as we see these the jobs reports. What are small businesses saying about staffing and what their needs are and how they're able to even meet those needs?
They absolutely say it's still a pain point. In fact, half of the small businesses in this report say they're struggling to get the staff that they need, say that they're hiring and struggle to get the staff that they need, and about a quarter of small businesses say it's a major issue for them. And absolutely, it's another area of uncertainty when you think about taking on those big projects. Am I going to have the staff that I need to capture those growth opportunities? So it's absolutely a pain point.
Okay.
And Anna, building on that, because we know that AI is the buzzword, we're seeing it on the markets everywhere. If you're a small business and you're looking at this, as we look at how they're planning to deploy it, we saw in the study saving time, data security, customer service. What sort of support, though, do they need to actually bring that to fruition? And as we mentioned, to have the skilled workforce to be able to provide these services?
Yeah, we would describe the findings in this report as small businesses are at least AI curious. I'd say that's how we describe it. 40% say they're already using AI in some way in their business. And I have to say that really surprised me. But then when we dug into it and what they're using AI for and what they're excited about, it's actually very typical with an entrepreneur's profile. So the number one use case they want to deploy is finding more customers. That's always the first thing a small business wants to do. So think marketing, thinking ad optimization. Then they want to use AI to better service their customers, so make it easier for customers to find what they need and do more business with them. And what I found was really interesting is many small businesses saw AI as possibly leveling the playing field. They see many of these tools as being much more widely available. So they say, hey, maybe AI is going to help me compete better with the big guys.
Speaking of that, let's go back to staffing. Did any of the small businesses talk about, because we've had many conversations about AI and robots. Do they expect to employ more automation in that respect and using literal robots to do some of the work that they need?
There was a really funny comment from a small business owner who talked about the next generation. So he has kids who are in the business. Yeah. He's hoping that AI helps make his kids smarter and maybe make up for the fact that they don't work as hard as he does. But he hadn't gotten fully to robots yet. He was looking for a way to enhance his staff base, which included his family members. I think the fact that small businesses are hiring, are struggling to hire what they need. They're no way in robot yet. They start with the customer always, and that's where they're focused on deploying AI.
All right.
Well, apart from you sort of banking on our kids to be the next generation to fix all of this for us, I do want to ask you, when you talk to some of these small business owners, what do they see as the top barriers to really growing their businesses right now?
Well, small businesses are always focused on getting more customers. I was looking back at this thing we have at American Express called Shop Small or Small Business Saturday. Hopefully you'll see the ads over the summer. You'll get out there and shop in the small businesses around the corner. That's a program that we launched in 2010. So really in the middle of that recession that you were showing earlier, because small businesses always have this long-term need to grow their customer base. Then we talk about cash flow in an uncertain environment. That pain point clearly gets more acute. And really making sure that small businesses have those tools, even in a tighter credit environment, is really critical. Flexible, easy to access line of credit products. Of course, we also have a series of small business cards that many business owners use to run their business. And that's where we're going to stay focused to navigate whatever's ahead.
We do thank you for joining us this morning. Anna Mazda, American Express Group President of Global Commercial Services and Credit Fraud Risk, and Yahoo Finance's Diane King-Hall. Great conversation. Thank you for joining us.
Thank you.
All right, coming up, Nvidia's stellar earnings report. Shares are soaring today. You see up almost about 28% there. That's after topping Wall Street's expectations. We'll deep dive into the company's latest financial results with Daniel Morgan, Synova's Trust Senior Portfolio Manager. Stick with us. Now for a quick check of what's happening in the markets from the floor of the New York Stock Exchange. Yahoo Finance contributor Remy Blair is there now for us. Remy, what are you watching this morning?
Well, the major U.S. stock averages are trading on a mixed note, but we are seeing the Nasdaq Composite Index rally by triple digits, up by over 1%. And this does come on the heels of that stellar earnings report from Nvidia. And as Nvidia shares rally in New York morning trade, we're seeing the semiconductor sector higher as well. And here on the floor of the New York Stock Exchange, there's one company with a very enviable ticker symbol, and that is AI. Now, that company, C3.ai, has seen shares open higher, and its stock is up by 150% year to date. Very recently, C3.ai's company CEO provided an earnings update and said that enterprise demand for software AI is exploding and that it expects to top forecasts for its fiscal fourth quarter. And sticking with the theme of AI this morning, Meta shares are higher. And the company recently did announce that it is building a custom chip for running AI models as it invests in infrastructure. It is also building AI models that can recognize over 1,000 languages as well as produce speech. And these models will be released on GitHub. But CEO Zuckerberg recently stated that it sees an opportunity to bring AI agents to people. Last but not least, Microsoft shares are higher this morning, and this does come as its company's president, Brad Smith, announced principles for regulating AI. Now, Smith did announce a framework at an event in Washington, D.C. today, backing the creation of an agency to regulate the industry. As AI advancements continue to take place, it will be important to create guardrails for that technology.
All right, thank you for that update. Remy Blair there for us on the floor of the New York Stock Exchange. Well, Nvidia shares are surging today after releasing its Q1 earnings report. It's clear investors are bullish on the chipmaker's AI business. Rosenblatt, JP Morgan, Jefferies, Goldman Sachs and Citi, just to name a few companies, all raising their price target on the stock today. For a deeper dive into the company's latest financial results, we're joined by Daniel Morgan, Synovus Trust Senior Portfolio Manager. Good to have you on the show here, Daniel.
Hi, Rochelle.
So first, good to have you. So as we look at the stock price reaction, especially to that forward guidance there, that second quarter revenue expected to come in at $11 billion, but about 50% higher than the street was expecting. How would you sum up what's been happening for Nvidia right now?
You know, Rochelle, what's interesting is, we had the FANG stocks report last month, and pretty much every conference call, AI was mentioned. I think you guys even did a poll like 45 times or something to try to get the stock price to go higher. But we had really no material, tangible evidence that AI was actually impacting these companies in terms of profitability. But what's so critical about this NVIDIA report is this is really the first technology company that has come out, at least on this earnings cycle, where we actually see tangible evidence of the impact of AI. If you look at their data center group, it came in at $4.38 billion. The street was looking for about $3.9 billion. That was about an 18% quarter-over-quarter increase. And it's estimated that about 65% of the revenues that they generate in their data center group is through deep learning, about 90% for training, about 10% for inference. So we're actually seeing, Rochelle, tangible evidence that's coming down and showing in the profits of a company that AI is for real, where before it was always, like we talked about before with Meta saying they're going to produce their own chip. Well, what does that mean in terms of profits? But we're actually seeing that with NVIDIA, and that's why the stock is really doing very well today.
Certainly that use case, that missing part there for Meta at the moment. But looking at some of the valuations that we're seeing, putting NVIDIA near the $1 trillion market cap status, do you think that's well deserved?
Well, there's no doubt, Rochelle, that NVIDIA is trading at a huge multiple right now. On a trailing basis, it's almost astronomical. If you look at it from a fiscal year 2024 earnings estimate, I know that number moved up after that new guidance on the second quarter of 24. It was trading about 70 times earnings, but it's probably north of that after the big run-up that we've had. Is it a company that we can say is in that $1 trillion club along with companies like Microsoft and Apple? I think we can. It's been trickling and hitting that point and bouncing back again. But we have to start looking at NVIDIA. This is going to be a huge statement, but it may eventually outdo some of one of these FANG stocks and find itself in one of those big five tech companies that represent, let's say, 25% of the total market cap in the S&P.
I mean, that could be, game changing when you look at how NVIDIA is moving and you look at the sort of interest that we're seeing here. So we'll have to hold you to that. We'll keep an eye on that for you. I do want to ask, though, because when you think about the future, especially of generative AI, you can't talk about that without talking about Taiwan Semiconductor Company, because essentially they're the ones who can most reliably create the kind of chips that NVIDIA needs for this next gen AI. So what is your take when you sort of have that potential wild card when you consider what's happening with China and the US over this chip fight?
You're right, Rochelle. And, I don't think there's any short interest or sell recommendations on Wall Street right now for NVIDIA. And the question is, what can go wrong, right? Well, what could go wrong would be some sort of increase in tension between China and Taiwan that would jeopardize Taiwan Semiconductor's ability to make chips for NVIDIA. For your viewers out there, NVIDIA is fabless. They do not have their own plants. Intel does. They're a company that's strictly an engineering and marketing company. So they rely 100%, as you said, Rochelle, on producing their chips in the Taiwan Semiconductor manufacturing facilities. If for some reason there was an increase in tension between China and Taiwan, that would jeopardize that ability to produce those chips. That would be devastating, as you said, for their AI initiatives going forward. Hopefully that won't happen. Obviously, there's a huge move now with Intel building foundries potentially in Ohio and potentially in Arizona that maybe NVIDIA would eventually start to use them to produce chips here domestically. But at this point, they are very susceptible to any issues with TSM.
And so to that point then, who are the biggest winners and losers then that come with NVIDIA's strength in this space?
We mean in terms of competition against other companies in AI, or?
Yes, in terms of chip manufacturers. I mean, we're looking at Intel right now under a lot of pressure, down more than 7% right now.
Yeah, so we know that Microsoft announced a couple of weeks ago that they are going to infuse additional capital into AMD to build AI chips. We know that AMD has come out with their MI300, which is a competitive chip in that space. Pretty much all the major chip producers, Rochelle, have a focus on AI, including Intel. You look at Alphabet has their Tensor unit. You've got Apple is in that space. You have Xilinx. There's really a host of companies. But I will say this, Rochelle, and that is that a lot of the chip manufacturers have existing chips that they have produced for many years that are being used for other sources, and they're being kind of recast as AI chips. Whereas NVIDIA has their Hopper line, their H100, which is a very specific chip that's used in AI. So I think if we look at the field right now in the chip space, you'd have to have AI in terms of NVIDIA in the pole position, and then everyone else trying to play catch up with a lot of these companies still in the formulation, so to speak, of specific AI chips. So it's really wide open, but NVIDIA is leading the pack right now.
And what are the chances that people can keep up with NVIDIA? I mean, when you look at how cost prohibitive it is to create these, especially, some of these fabrication places as well, and you think about Taiwan Semiconductor, really, how much longer will it take before someone really can catch up with NVIDIA?
It's going to be really tough, Rochelle, because right now the players are TSM, you've got Samsung, Global Foundries. There's only about a handful of actual companies who produce chips. That's why it's going to take a very long time for Intel to make that transition over to becoming a major player in the space. It requires a tremendous amount of capital. You have to go out, build the factories, you have to buy the equipment from the companies like KLAC, Applied Materials, Lam Research, ASM Lithography, and you've got to get that capacity up. And then the domestic producers should come over and start producing chips here domestically. But it's still something that's way off. So if there was an issue with TSM, Samsung is in that same region, it would be very challenging for NVIDIA going forward.
Really an incredible earnings report there. Daniel Morgan, Synovus Trust Senior Portfolio Manager, thank you so much for joining me today.
Thank you, Rochelle.
All right, coming up, optimism from the House Speaker that a deal will be reached on the debt ceiling isn't enough for Fitch. We'll ask a leading academic how to resolve the debt ceiling standoff without risking a default. America's political partisanship could cost the nation its AAA credit rating. Fitch Ratings placing the country on rating watch negative, signaling it could downgrade if lawmakers are unable to raise the debt limit. Now, while Fitch says it expects a resolution to be reached before the X date, lawmakers' failure to meaningfully tackle fiscal challenges signals risks to U.S. creditworthiness. Now, in 2011, the S&P gave its first ever credit downgrade to the U.S., cutting its rating to AA+ and sending Treasury yields down. More than a decade later, that agency has still not restored its rating. Joining us now is Lan Hee Chen, Hoover Institution Fellow, and he recently authored an opinion piece for CNN titled How to Resolve the Debt Ceiling Standoff Without Risking a Default, something I'm sure a lot of us would like to know. What would that involve?
Well, quite simply, it's about kicking the can down the road, essentially creating an environment where they can resolve some of the broader fiscal issues, because I think that's the challenge in the current conversation. They're not focusing just on raising the debt ceiling. They're having a conversation about what the appropriate spending levels are, what the appropriate fiscal policy is. And the point that I make is simply that is an appropriate conversation to have in the context of the budget process, which would happen later this year. So punt the debt ceiling deadline through early October, and that puts pressure on them to resolve not just the debt ceiling later this year, but the fiscal issues that the Republicans, for example, want to address. So some might argue that it's creating a dual fiscal cliff, if you will. But I would simply say that you've got to think about the political pressures and political incentives involved and try and align them a little bit better in thinking about how we resolve the current crisis.
And I mean, when you look at the amount of time they have to even to decide whether or not to kick the can down the road, I mean, we have a holiday weekend coming up, you know, the holiday on Monday. How much time do they actually have to realistically get this into play?
Well, they're going to have to work through the holiday weekend. I don't think there's really any ability to take time off right now, given the proposed X date of June 1st and maybe a few days of wiggle room beyond that. So they are going to have to reach a resolution. You know, Speaker McCarthy had originally said he wanted to see the framework of a deal by the end of the week if they were going to have the ability to get it vetted and voted on before we reach the X date. That date is perilously close. So we're within probably a couple of days of having to get that deal done. There is a lot more optimism, which I think people should take positively. But at the end of the day, there's no deal until there's a deal. And so we're going to have to see how these next 48 to 72 hours play out.
And we've been seeing the market in something of a holding pattern at the moment, you know, really not sure what's going to happen. But what, if anything, is really going to incentivize both sides to sort of rush and at least come to something, whether it's kicking the can down the road or coming to actually a substantive deal?
Well, I think it's going to have to be, markets signaling in a more definitive way that there's real concern about that deal not happening. I think the reality is, yes, markets are in a holding pattern, but the default assumption, I think, for most people continues to be they'll get it done. They'll go right up to the deadline, and then they'll get something done. I mean, we've seen this movie before from the last fiscal standoff that we had in the early 2010s. So it's difficult to make firm conclusions, I would say, about how legislators will act. And to a certain degree, I think they all understand the urgency of it. That having been said, I think until there is a more urgent signal that people really and honestly believe a deal might not get done, then I think you're going to continue to see them moving at the pace that they're moving, trying to get a deal done. I think they understand, as I said, that they've got to get this done. It's just a matter of actually crossing all the political bridges that need to be crossed.
And in the event, obviously, this would be sort of uncharted territory in this day and age, at least. In the event of a default, what should people know about their finances and what they should really expect in terms of fallout in the initial days?
Well, I mean, I think the fallout would be tremendous. I think obviously you would see significant pullbacks in a number of different parts of the economy. I think you'll obviously see a market reaction. I think there will be significant and catastrophic impacts were that to happen across the economy. I don't think it would be limited to any single sector. This is not something that just affects technology or just affects hospitality or just affects one element of the economy. So I just don't see that happening. I know you hear a lot of people say that, and we're in unprecedented and uncharted territory from a political perspective. That having been said, outcome of such a default or failure to raise the debt ceiling would indeed be catastrophic. And I think people realize that. It's just sometimes the urgency doesn't always meet the moment. But I do think, for what it's worth, everything I have heard from people on Capitol Hill, everything I've heard from people who are involved in these conversations right now, is that both sides are working earnestly to achieve some resolution. I think the question will be, once the resolution is reached, will that be acceptable to Democrats in the Senate and Republicans in the House? And there's a political dynamic that we can't forget here.
And we know, of course, Treasury Secretary has set that June 1st X date, seeing some flexibility, some sort of different estimates as to what that X date might actually be. But should we really be taking the June 1st X date at its word, do you think?
Well, yeah, for a while, I think people were wondering, is this a political posturing technique that Secretary Yellen and the administration are using? I think given where revenue collections have been, given everything that we've seen, that June 1st general time frame is probably an accurate assumption regarding when, in fact, the debt ceiling needs to be raised. People have to remember, it's not a hard date. It's not like June 1st at midnight, we turn into pumpkins. It is a range of dates when we believe that the extraordinary measures being used by the Department of the Treasury are no longer going to be sufficient to cover the obligations that the U.S. government has. And so that could be June 1st, it could be June 3rd, it could be June 5th. That June 1st date is an estimate. And so once we get a little bit closer, presumably we'll have a little bit more of a sense of, okay, what is the exact date? But, I think folks need to understand that it's not like your taxes being due April 15th. June 1st is an estimate, and it continues to be a relatively soft estimate.
And certainly important context there to add. Lan Hee Chen, thank you so much. Hoover Institution Fellow, thank you for your time this morning.
Great to be with you. Thank you.
All right, coming up, the possibility of an economic downturn. It's become a major point of discussion for investors. Are these talks of a recession being overhyped? We'll discuss on the other side of this break. The hang-up in Washington's debt ceiling negotiations is turning out to be longer than expected. President Biden and House Speaker Kevin McCarthy spoke on Wednesday to continue talks about America's outstanding debt limit. And while there's no deal yet, investors are wondering how to safeguard their finances if the U.S. defaults on its debt. Let's bring in Lawrence Sprung, Midland Financial founder and wealth advisor, to discuss this. Thank you for joining us. So I first want to ask, in terms of the questions that you're getting from people, what are they most concerned about when they're looking at this debt ceiling standoff continuing?
Yeah, I mean, I think what they're looking at is how is this going to affect me, right? Because financial planning is very personal and people want to know how is this potentially going to affect me? And we have to, we really don't have any kind of precedence here in terms of an actual default outside of 1979, which was a clerical error. The only closest indication we have is what happened in 2011 prior to us coming to a deal and actually getting downgraded, which, obviously caused some significant declines even without a default.
And so then in the short term, as we're sort of still in this holding pattern of volatility here versus really taking the long-term view, assuming that the US does at some point get this settled here, how should people play this?
I think the important thing is if you have a plan in place, follow the plan, because this is going to end up being a short-term event in a long-term situation, right? And two, if you don't have a plan in place, I think that this should encourage you to make sure that you get one and have one, because this may or may not be the last time we see these types of negotiations happen with regard to debt ceiling or even other financial, economic, or market events.
And so what did we learn from 2011 in terms of perhaps some of the safe havens that people tend to go to and which ones they should actually be heading towards?
So I think one of the things we saw was the market had a sell-off, I think, in the S&P about 19%. So there was a significant sell-off. That's the bad news. The good news is it recovered rather quickly. So if you're concerned in the short term, there might be opportunities to flood to some safe havens like treasuries or money markets in order to secure some of that debt, in order to secure some of those declines. But at the same time, if you have a longer term time horizon, chances are there may be a short-term impact, but for those who are longer term, it may also provide a long-term opportunity to enter the market if this were to happen.
And so for people who did want to enter the market right now, what sort of caution or advice would you give them about how to approach when they're trying to pick, do I look at perhaps ETFs or do I look at, something more broad-based and diversified?
Yeah, I think right now, if you are looking to enter for the first time or you have some money on the sidelines, I would probably take a wait and hold approach in terms of waiting to see how the negotiations go. If we end up in a situation where there is a default, which I still think is very highly unlikely, but if we did and there was a market sell-off, that could present an opportunity. I would wait to see how this plays out because it's only we're going to probably see a resolution in the next week or so. We'll see if we have a deal in place or if there's a potential for default. So I think that would be a wait and see approach for those looking to enter today would probably be the best and wisest approach.
And based on what we saw in 2011, then, in terms of how long the volatility lasted or the most affected sectors at first, what should people keep in mind?
I think, again, we want to take a long-term approach. If you are an investor, if you're a trader, you might have a much different approach to this whole situation. And you may be taking advantage of what's going on today and not be willing to wait. But if you have a more long-term approach, then having that diversified portfolio, we always work with folks in designing the most diversified and least expensive way of entering the market and investing their portfolios. So I would do the same way. If you have the opportunity to invest due to a market decline, take that opportunity, diversify, and build yourself a long-term, inexpensive portfolio.
And for people who are sort of close to retirement, looking at this volatility and really not sort of wondering what to make of it, how would you advise them versus someone who's sort of just beginning or in the middle of their work life?
Obviously, that's a much different scenario. I would argue they have to take a deep breath and they have to look at what monies they may need in the short term versus the long term. Those funds that are more long term in nature, it will be probably a similar effect to their portfolio in the long term as it was or would be for a younger investor. For funds that they may need in the short term, next 6 to 12 months, they should be identifying or maybe getting more liquid than normal in order to have those funds available so that they're not subject to the gyrations of the market due to the debt ceiling negotiations.
I do appreciate you joining me this morning. Lawrence Sprung there, Midland Financial founder. Thank you so much. Well, high inflation, the threat of a debt default, and volatility on Wall Street adding to growing concerns about a potential recession in the US. But are talks of an economic slowdown being overhyped? Yahoo Finance contributor Vera Gibbons is here to weigh in. So, Vera, why does it feel like we've been talking about a recession forever at this point?
It feels like we've been talking about a recession forever at this point because we have been talking about a recession forever at this point. Going back, a couple of years, right around when the pandemic hit, we were talking about a recession. And there's a couple of reasons for this. First of all, we are in a world of high inflation and high interest rates, and that does typically end with recession. So that has people thinking we're headed down the economic rabbit hole. And another reason we're hearing so much about a possible recession now is if you look at the yield curve, which tracks U.S. securities, it is inverted. And that's one of the top signs that economists look to see whether or not a recession is coming or not coming. And that does indicate that it is coming or a bear market is coming. So that's one of the top indicators that tells them, be on the lookout. Now, in terms of when, nobody really knows. I mean, some economists have said, guess what? We've already had a couple of recessions, one in the first two quarters of 2020 because of the COVID-induced shutdown. We had another one, albeit a milder one, in the first 2 quarters of 2022. Other economists are saying, you know what? We did not have a 1 and 2 recession, but we are, in fact, expecting a recession, whether it's a third one or a first one, because of the boatload of inflation that the Fed is continuing to fight. Also because there have been a slew of layoffs, especially in the tech sector and in the media world. Granted, the job market overall is extremely strong, but there has been a sign of more layoffs coming. And then if you look at the stock market overall, which is a forward indicator, it is showing that it's where decline for the year. So that does suggest bad things are coming. Now again, it's like the crystal ball will tell you, oh, is it going to happen this month? Is it going to happen next month? Some economists are saying the end of the year. Nobody really knows. Nobody really knows.
And it almost feels like we're speaking it into existence as well. And keeping in mind, so technically, a recession is defined by 2 consecutive quarters of negative growth. So have we already been through this several times over the past few years? And is this any different?
Yes, that's what some economists are saying. We've already gone through this twice. So why aren't all economists saying, yes, we've already been through 2 recessions over the past couple of years? They're in denial over that to some extent. I think things just seem really uncertain, really kind of wonky right now. Recessions in general are pretty hard to say start date, finish date. But if you think back to the Great Recession, in hindsight anyway, it's what started in 2007, it was obvious. I mean, people were buying homes they couldn't really afford. Interest rates went up. They couldn't afford the homes. They lost them. There were foreclosure signs all over the place. Now, I feel like the warning signs are so different and so cloudy and so murky that our judgment is kind of off too. We're in uncharted territory altogether. But the one thing that does look certain at the moment anyway, is that the job market is in fact strong, the labor market's strong. So there's no sign of any kind of recession activity there. In fact, if you look at the job market, it is booming. And when you have a booming job market, you have consumers who are pretty happy. They're out there spending. You have some who have cut back on, discretionary costs a little bit. But if you look at service spending, restaurants, hotels, bars, all the travel that's going on, people are really dead set on actually spending and having fun. So that's kind of keeping us afloat. All eyes are really on the consumer in general going forward because there's a little bit of bubbling going on there. We have seen higher delinquencies in the auto market and in the credit card arena as well among subprime borrowers. So we're watching that. But I think overall the consumer is holding pretty strong under these kind of very strange circumstances we're under.
It's true, because when you think of how a recession typically goes down and what makes things different this time, you mentioned the tight labor market you have there. Is there anything you think people should be bracing themselves for, especially when you look at the consumer and you see this strong labor force as well?
Well, I was talking to a bunch of economists, and they did say that some consumers have, in fact, made the necessary preparations in case a recession is coming. They've got the emergency fund set up. They're trying to pare down the credit card debt. But you have the subprime borrowers, which I'm really paying particular attention to, because we're seeing those guys, as I mentioned, default on the auto loans, credit card defaults or delinquencies are rising a little bit as well. You try to get ahead of it as much as possible. The one thing that's holding us together right now is that very strong labor market. But, there's some people who are saying more layoffs are coming just because we've had them in the tech sector and the media sector. They've been limited to, a few sectors, doesn't mean that we're not going to see widespread layoffs down in the future. I think the market behavior is very indicative of what's going on. It's pretty wonky. It's very volatile. And again, that is a forward indicator. So to be determined.
Indeed. Well, thank you for that breakdown. Yahoo Finance contributor Vera Gibbons, always good to have you on.
Thank you.
All right, well, that's it for now. I'm Rochelle Akufo. Yahoo Finance will be back with you at 3 p.m. Eastern. See you then.